Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleague Surabhi and Nigel. Guys, morning.
Hi, morning folks. Slightly quieter because we don't have overnight US market action.
Yeah.
But then there's still plenty in the air when it comes to trade talks. There are lots of course, local news flow as well. So plenty that we have to go over today.
Well, that's right. And the rain has subsided as well. So that's pretty okay. I think last evening we were a bit worried about how we'll get home. And this morning, Prashant, I think one queue less to track. Other you get up, you have to look at the US markets. You know? Well, chill.
The kids were really looking forward to a rainy day.
Yeah.
That rained out, washed out, no school.
Yeah. But that didn't happen.
Okay, well, let's just quickly run you through what you need to know as you begin this new session. So no US. I mean, that's straight up the first point. Markets were shut because of US markets were shut because of Memorial Day holiday. By the way, UK markets were shut as well. So in that sense, not very much by way of cues. By the way, US Treasury futures are trading in Asia this morning. The 10-year closed at 4.51, remember, on Friday. Action will only pick up, as we go into the latter hours of the day, as we get closer and closer to the European session. Volumes pick up, and of course, right before US and once US starts trading. But I think, and I'm just sort of putting this out up there because bond markets and bond yields at the long end have been rising. There's been this gathering pressure across the board, not just in the US and Japan, UK, etc. And that remains the focal point from an equities perspective as well. Fiscal credibility remains a major drag on long end US treasuries. With regards to that one big beautiful bill, as Trump has put it, the spending bill. So, tax cuts now, spending cuts later. It's the usual trickery, which I think we are seeing once again. A lot of people actually at the margin are disappointed because this was being seen as a bit of a test that Trump is going to be fiscally conservative, fiscally responsible, but who can sort of, I guess, resist the allure to spend away and sort of, let it be the other guy's problem to manage the budget. I think that's essentially what's playing out, but we'll have to give it some more time till this is actually this passes the Congress fully. Now, as I said, bond markets are the focus. Treasury has announced $183 billion worth of supply this week. So there are auctions on Tuesday, that is today, tonight, that is Wednesday and Thursday. And I said this yesterday as well, the 7-year paper is being issued, is being sold on Thursday. And I think that's the longer end of what we're going to see. And demand here will be important in that sense. Now, just one more bit of news flow. Germany last night, gave Ukraine the green light to strike deep inside Russian territory. This is significant because and the German chancellor essentially said there are absolutely no range limits anymore. Russia, of course, is calling this dangerous provocation. So you basically are talking about Ukraine using Western weapons, NATO-supplied weapons, German-supplied weapons, and other countries, and using those weapons to strike deep inside Russian territory. We're not looking at a ceasefire. Forget a ceasefire. We're looking at maybe escalation from here and no end to the war in sight. 2022 it started. We're in 2025, and there isn't very much which indicates that this is going to end anytime soon. Now, just to sort of tie in the levels here, news flow is limited. But yesterday, the Nifty continued its bullish momentum. We closed off the highs of the day, but 25,001. Nice round Shubh number. 25,001 was the final close, by the way, on the Nifty, as you can see. So we found support at the 20-day moving average. Immediate resistance is 25,116. We got very close to it, but just under 25,100 as of yesterday's high. Once that gets taken out, which I think it should, the next upside level is 23,310, which is the 78.6% retracement of the entire fall. And on the downside, 24,462, which is the recent low. And then the 20-day moving average comes in, which is 24,602. These are the two support levels on the downside. For the Nifty Bank, we could not close decisively above the high 55,695. So that remains the first level to take out, 55,695. And of course, I mean, once this gets taken out, I think we're looking at a retest of the all-time high on the Nifty Bank, not very much between where that number is and the all-time high. Support comes in at 54,576, which is the recent low, and the 20-day moving average, which is 54,995. So that's the picture as far as levels go on both the Nifty and the Nifty Bank. GIFT Nifty will give you a quick sense of how we are likely to start, and then we'll pick it up from there. It's absolutely flat, 15, 16 points lower on the GIFT Nifty. Surabhi.
Oh, well, absolutely. And actually, flat is the trend across most of the Asian markets. We don't have very clear directional moves across Asia. And the picture is fairly mixed. You have the Hong Kong Hang Seng, which is rebounding today because it was the down market yesterday. So there's some green out there. But then the mainland Chinese market is flat. The Nikkei is cooling off. So it's a little all over the place across Asia. US futures, however, last time I checked, were indicating a positive start, 1%. Remember, because tonight is when US markets will get to react to the fact that this 50% threat of tariffs has been pushed back as far as the EU is concerned. The currency markets are still very, very interesting. The dollar continues to hurtle down lower and lower. The dollar index is close to 1 month lows now. The last time we were at similar kind of levels, 98.20 thereabouts, was April. 21st of April was the low. So we're getting back to that level. The rupee has been strengthening, and I just want to mark this because yesterday was an important day for the dollar rupee. In intraday trades, it was actually going above the 85 handle as well, and the rupee is not alone. A lot of other Asian currencies have been strengthening. The yuan, for instance, yesterday hit a 7-month high. So the currency market action continues to be quite important. For us, of course, the Nifty at 25,000, that Shubh level, as Prashant calls it, 25,001. So let's see. It's consolidation, but the bias has been positive over Friday and yesterday as well. The flows picture, more domestic buying than foreign buying yesterday at a net level because foreign institutional investors bought net stocks. The buying was just about 140 crores. DIIs, as you can see, the number is there, northwards of 1,700 crores. Now, plenty of interesting local news flow, as I said. Number one, this whole war of the weekly expiries, it's getting more and more interesting because SEBI finally came out with its final policy on this. Till now, it was a consultation paper. And, the market regulator has indicated that weekly expiries will be limited to just 2 days of the week. And SEBI is going with Thursdays and Tuesdays. So all exchanges have to decide, pick one of these days. And then that's how the weekly expiry will happen. In fact, it's told exchanges to come forward with their independent proposals by the 15th of June and decide. And Bloomberg this morning was indicating that NSE will probably ask for the Nifty expiry to be on Tuesday. So let's see how this plays out. Watch for BSE as well and how the stock fares today in trade. Speaking of the F&O market action, there are new entrants as well. 361 Wealth Management, Amber Enterprises, K Fintech, and PG Electro. All these stocks get added to F&O. This is effective the 27th of June. So some interesting trading action expected there. And interesting block deal action as well expected today because our colleagues have been indicating that Indigo, that's the first one that could be on the radar. Rakesh Gangwal could be selling up to 3.4% stake. The floor price is about 5,175. The other one is PG Electroplast. And watch for PG because here promoters are likely to sell and they could be selling as much as 5.6% stake. So this is going to keep both of these stocks in very sharp focus. So lots of local news flow, lots of stock-specific action that should drive the day today. Nigel.
Well, that's right. In yesterday's trading session, as you all said, the Nifty managed to get to that Shubh level of around 25,000 odd mark. But it was without the FIs because the FIs were on a holiday. If you look at the gross participation yesterday, it was much lower than what we've seen on an average in May 2025 because the US market, UK market as well was shut. That's one probable reason out there. Now, yesterday's trading session, the Nifty went up, but the VIX as well moved up. Sometimes, that's a little bit of a caution, though I don't think it's that bad because the VIX is still very much at the lower end of the range, at around that 18-odd level. Not a cause of worry till it gets to the 20 to 23-odd mark, which we saw earlier in the series itself. Moving to what the rollover picture, then we have the monthly expiry that will play out. And the Nifty rollover actually is much higher than what we saw in the past series. On D-3, that is the expiry is 3 days away. If you take D-3 and you compare it with the previous series, this time around it's at around 50% odd. The last time around it was close to around 30%. So the Nifty rollovers are higher, while the Nifty Bank rollovers actually are relatively lower because this time it's at around 35%. The last time around it was around that 45% odd mark. So Nifty rollovers relatively higher. What do the FIs do? Well, they added more longs than short positions in the ratio of close to around 2 longs for every 1 short position. They continue to remain net short with close to around 65% of their positions on the short side. So that's come down a little bit from around that 68% odd mark. And in absolute terms, the FIs, they are net short with 50,000 contracts on the short side, while the clients are net long with close to around 50,000 contracts on the long side out there. Which brings us to the options data. Since we have that expiry that's going to be playing out in the next two or three trading sessions, the 25,000 call, 25,000 put, fairly active in trade yesterday. Same strike, you see writing on both these two, then it appears as a strategy at plays. It's known as a short straddle, where those traders, they are looking at writing both the strikes and pocketing the premium. In this case, it's around 400 rupees. So those that are moving with this strategy, they are looking at the 24,600 mark to hold out on the downside. And on the upside, 25,400. But in the near term, you've got some crucial levels. So going by the options data, the 24,800 mark for the day, you don't want this level to get breached. On the upside, this resistance level, that's the mark that I'm looking at, going by the options data and going by the call writing that we saw at around the 25,000 call or thereabouts. But the 20 DMA, that's important. That's a deeper, support level that we're looking at. The Nifty Bank, it's gradually making its way to around the 56,000 odd mark. Today could be the day that it goes ahead, tries to challenge that 56,000 mark and actually crosses above that mark. So we'll have to keep an eye out on that. The stock that I'm looking at for today is going to be Eternal. Yesterday as well, the stock got, pulled back a little bit. That's because, in fact, we did see the expectation that was there from the street with regard to the FTSE rebalance that was a little bit more severe. So yesterday it got hit by close to 4.5%. Today is when the FTSE rebalance takes place in the final hour of trade. So you'll expect passive selling of close to around $300 million approximately. The MSCI rebalance will be on Friday. So I'll keep an eye out on the stock. Remember, this is a bit of a blow for the stock in today's trading session. But at around 215, 220, that's a crucial support zone. $300 million of passive selling is what we look forward to.
All right, Nigel, thank you very much for that. So that's the setup and lots of interesting stuff to track in terms of those individual names as well. Ben Powell is with us, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, great to have you with us here. Thank you for your time. We'll talk about the bond market in just a bit and whether that'll start to hurt equities. But I just want to start with this Russia-Ukraine thing. Trump has kind of made it clear that he's ready to talk to Russia even though they don't stop fighting. I mean, even without a ceasefire. And I think it's pretty clear that, Russia does not want to stop because they think they're winning. Now, this overnight news that Germany essentially allowing Ukraine to use their weapons to hit targets deep inside Russia, is that a new phase of the war in that sense? I mean, forget a ceasefire. We're now probably looking at escalation.
Good morning. Great to be with you. Yes, we continue to be in a very difficult geopolitical environment. And I think this is another example of how the investment kind of landscape that we're all trying to navigate is completely different to where we were perhaps 5, 10, 15 years ago, where with hindsight, I guess we can say at least at the global level, these risks, be it kind of normal economic stuff of high volatile inflation, tariffs, or much more seriously, the geopolitical risk, including military risk, clearly have moved from being relatively benign back in that previous era to a much more disconcerting situation now, which is something investors are going to have to learn. I'm afraid we're going to have to learn to live with. The idea that we're going back to a kind of benign macroeconomic or geopolitical environment, I think is extremely unlikely. So as investors are kind of waiting for the clouds to totally clear, I actually don't think is really an option. We're just going to have to learn to live with this kind of backdrop and try and navigate it as best we can.
Ben, hi, great to have you on the show today. And that's one part of the problem. The other is obviously trade, right? And we still don't know. I mean, there are no final answers. It seems the deal with the Japanese could be progressing quite nicely, given the statements that have been coming out. With the EU, now this whole 50% threat is looming. What's your sense, Ben? I mean, and even as these deals get done, I mean, eventually tariffs are going to be much higher than where they were before this, U.S. president took office. Have the markets adequately priced the slowdown or the quote unquote recession? I mean, the ground economy is still doing very well in the U.S. is what we understand. Your thoughts?
Yes, so I think you made a very important point there en passant, which is there's many things we don't know, but I think we can clearly say if we look at the UK, which is the one kind of trade deal that's done and dusted, that nominally at least is a friendly nation to America, and even the UK got hit with a 10% tariff. So I think maybe one thing we can feel reasonably confident about is 10% is something like a best case. You know, again, if that's the kind of rate that the deep ally, historic ally going back decades, even centuries gets, I guess we can assume that's kind of a best case scenario looking forward, which to your point means even hopefully as we get a bit more clarity on the many dozens scores perhaps of these trade deals being worked out in real time, wherever we end up is going to be a totally different place from where we started, much higher. And what that means for us as investors, we think at BlackRock, BlackRock Investment Institute, is inflation will be structurally higher. It's arguably a bit strange, but for political reasons, and fair enough, politics is a real thing. Obviously, voters do what they want to do. But the consequence of this should be a kind of self-induced inefficiency. You know, we are deliberately injecting less efficiency into the trading system for political and maybe reasonable justification, but as a pure kind of economic outcome, making global trade less efficient, making it a bit clunkier, trying to move stuff away from where it's kind of cheapest to where you would prefer it to be, you know, with your friends or even at home.
But
I get it
Ben,
politically, but economically, it should mean higher inflation.
but got your point, but simple question. Can markets keep marching higher despite the reality you just described?
Yes, I think so. So on the equity side, I mean, clearly what we've seen in the last couple of weeks is the S&P US equities ripping higher, more than 20% higher. That's some people's definition of a bull market. So clearly, yes, equities can do fine, even with all of this going on in the backdrop, because of course these issues that you're raising are obviously extremely important and are going to continue to be so. But they're not the only game in town. And at least over the last several weeks, what we've seen is the AI, the artificial intelligence megaforce, has been sufficiently strong to be a big enough tailwind to offset even these very substantial headwinds. So yes, we at BlackRock continue to be overweight US equities. We fully understand there are many things to be concerned about. That's true and important. But there are also many things as equity holders that we like. And on balance, we think the tailwinds are stronger than the headwinds. That keeps us overweight US equities from here.
All right. Hi, Ben. Good morning. Good to hear that thought. And I think the last time we spoke as well, you did mention that valuations are still relatively attractive for the US markets and you'll continue to remain overweight US equities. Now, the point is that the dollar index actually has weakened. And normally that could see some kind of outflows, the kind of gush of money that we saw into the US equities. Do you think that could happen? And if that is the case, where does the money rush out to? Does it move to Europe or does it move to emerging markets? If in case you believe that could possibly happen because of the weakness we've seen on the dollar index.
Yeah, I mean, that's a fact, right? The dollar has weakened. That's true and important, and I think speaks to an important conversation that's going on in the market around US exceptionalism. Our view is the US is still an astonishingly, perhaps unique place on the planet, blending intellectual kind of capital, financial capital, and all of that. So that's still true and important. But to your point, I think there is a logical kind of consequence of this new, more fractured geopolitical order where we are going to look to diversify. Having all your eggs in one basket, even a beautiful basket like the US, feels a bit riskier given the volatility that we're seeing kind of all day, every day. So we would be looking to allocate carefully into other geographies, including selectively within emerging markets. So we want to be like picking our spots. Obviously, not all emerging markets are the same. So we would want to be cherry picking what we think are economies, sectors, markets which can benefit from these mega forces and do a better job, I guess, of being able to work through some of the headwinds.
All right, and Ben, India comes top of the list, or where do we feature?
We like India, yes. We think India is the right side of a lot of these kind of huge tectonic shifts that we're seeing. So India, in terms of the geopolitics, where we started the conversation, clearly India is, of course, a kind of a continent-sized country and economy, and everyone wants to be friends with India. I think it's neck and neck at the moment, but potentially India's GDP will be overtaking Japan's relatively soon in the next few quarters. So India's heft, political importance, and I still think, if I can say so, what some of the foreigners still fail to understand is the amazing technological kind of productivity advances we've seen in India over the last years. That's not a news story, but it's kind of true and very important. So the combination of demographic growth, labor force growth, multiplied by ongoing productivity gains is a story we continue to like. So yes, India is definitely one of the emerging market equity index we would be favoring.
Absolutely. And of course, Ben, as I think many foreigners have pointed out, the diversity, right? I mean, the absolutely diverse group of companies, industries, businesses, not minerals focused or tech focused or this or that. I mean, it's everything in that sense. Thank you very much. Great speaking with you, Ben. Appreciate you joining us, and it's a pleasure having you here on CNBC TV18. Till the next time. Well, I think let's just quickly look at the GIFT Nifty and what that is doing before we go any further. And I think that is indicating an absolutely flattish kind of a start, about 20 odd points lower, 15 points, 16 points lower. Let me tell you what's lined up here over the next 2 hours or so in terms of interaction. So you'll hear from the management of KEC International, 8:35, Vimal Kejriwal talking about the fourth quarter numbers. 9 o'clock, Vishal Manchanda of Systematics Group speaks to us about Divi's Laboratory Supply Agreement with a global pharma company. Aurobindo's fourth quarter earnings also in focus with him. Sridhar Sivaram of Veenam will be with us. He's a market master today. 9:30, we'll have the management of Jyoti CNC, outstanding performer in terms of the stock and of course business-wise as well. And we'll have Sakshi Gupta of HDFC Bank and Upasana Bharadwaj of Kotak Mahindra Bank who will be speaking with us at 9:40. This is, of course, macros in focus, 9:50. Our special program will play out a snippet of our interview with Rajiv Jain and GQG Partners, the largest foreign investor in the country. Towards the end of the program, it's commodities in focus, and Manisha will be in conversation with Ole Hansen of Saxo Bank, and she talks to him about metals as dollar falls and tariff uncertainty continues to remain high.
Well, time to slip into a short break. On the other side, we'll go full throttle on all stocks in our special top 10 segment. For the time being, I give you a sneak peek into the list. PG Electro Plus, we have Oro Pharma, Schneider Electric, Shilpa Medicare. They'll be reacting to positive news flow. While you have Interglobe Aviation that will be reacting to negative news flow. Add to the list Agility, KEC International, BrainBee Solution, Blue Dart, and Electra Green Tech. Take that break, come back, get into further detail on all of these names.
Welcome back. So as we've been telling you, cues across Asia are fairly mixed, which is why we're not getting a very clear directional indication, even from the implied open today. Markets are a little all over the place, very range-bound and a little directionless. Let's get the implied open up. Okay, about 13 to 14 points on the lower side. That's what we have. Lots of stocks as usual on our stock list. So let's straight away get to it with our team. Here's the CNBC TV18 list of top stocks to watch for the day. Morning, guys, to all of you. Let's first start with earnings later, but I think the block action could be very, very exciting today. Nimesh, good morning. Tell us more.
Morning, Sylvia. So 2 large blocks and 1 large OFS. So the fundraising spree continues. I'll start with Interglobe Aviation, much awaited block now finally happening. So the Ganwal family is selling another 3.4% stake in Interglobe today. The indicative price, the follow price, is at a 4.5% discount, which is 51.75. That's the indicative price. So 4.5% discount to yesterday's closing price. I understand the demand is quite strong, but the stock may open a little bit soft on the back of that large block. But the most important part is now there is a 150-day lockup. So the remaining 10% can't be sold for the next 150 days in Interglobe Aviation. So that's the first stock. The second stock is PG Electro Plus. Again, a large block. The promoter is selling nearly 5.6% stake via block deal. The deal size is close to 1170 crores. And again, there is a 4% discount to yesterday's closing price. And even there, I understand the demand is quite strong. Interestingly, even in PG, there is a 180-day lockup now for the promoter, so they can't sell further for the next 6 months. And the last one is Sagility. This is going to be interesting. A 15% OFS is what the parent is looking to do in Sagility. Of course, it's because of the minimum public float norm. So with this OFS, the stake will fall below 75. So the furthest supply won't come. But again, the floor price is at a 12.5% discount. So the stock may react a bit negatively to start with. The floor price is 38. Again, it's an OFS, so it'll get over 2 days. So 2 days for non-institutions, and for tomorrow, 2 days for institutions, and for tomorrow, it'll be for retail. So 3 large blocks, but the 2 important ones would be PG Later Plus and Interglobe. And interestingly, PG is getting added to the FNO as well from the next series.
Interesting. It's raining blocks, Nimesh. Huh?
Yeah, absolutely.
And the forecast is for cloudy skies and heavy rainfall, continued rainfall. Thank you very much, Nimesh, for that. Well, Aurobindo Pharma is the next one we're going to focus on. Ekta is here with details on the numbers. Ekta, morning.
Thanks for that. Well, largely an inline set of numbers, you'd say, for Aurobindo. So revenue growth was around 11% year-on-year, margins 21.4%, Street was anticipating 22%, and a profit which was a little below expectations, but it was flat on a year-on-year basis. Now, in terms of geographies, the US markets did well. So that, the company said, was driven by volume growth, stable pricing, new launches. It was up around 8.8% on a year-on-year basis in dollar terms, and versus estimates of around $430 to $432 million. So better than expectations. Europe also was okay. It was up around 17% on a year-on-year basis. The call is at 8:30 a.m. More details then.
Okay, all right. Thank you very much for that, Ekta. Let's go to Vivek now. KEC International came out with numbers. How do they look, Vivek? Morning.
Well, good morning. Well, KEC International, after a very soft H1, H2 has been much better. And especially when you're looking at Q4, it's been a very strong execution that the company has managed to deliver in the last quarter of the year. But when you're looking at what the company guided to as far as the whole year was concerned, the company has managed to miss estimates by quite a large margin, especially when you're looking at the top line growth. They started off the year expecting close to 15% top line growth. They trimmed it down to 12 to 14%, but at the end of the year, they managed to do a 10% growth as far as the top line is concerned. But let's have a look at how exactly Q4 panned out, which is quite strong. Revenues higher by 11% on a year-on-year basis, EBITDA up 39%, so very strong execution. And when you're looking at margins on a year-on-year basis for Q4 comes in at 7.8 versus 6.3%. Profitability higher by 77%. Order book, that continues to remain quite robust. Almost 34,000 crore is where the order book stands at currently, and L1 plus the order book close to 40,000 crores. So order visibility too is quite strong. The only blip remains the miss as far as the top line growth is concerned. And margins, remember, the company had guided to almost 9 to 10% band. That continues to elude most of the infra companies.
Thanks a lot for that, Vivek. In fact, we have the management will be joining shortly to detail their quarter 4 earnings and detail what's their plan with regard to FY26. Let's go to Mangalam, though. He's tracking Blue Dart as well as Brainbees Solutions. Mangalam, how are the numbers?
Well, operationally weak. For Blue Dart, the problem is that external environment is not very conducive. So 7% revenue growth is what the company has reported. The EBITDA has actually declined by about 5.5%, telling you that there's a margin compression of 200 basis points. And that's reflected in the net profit as well, which has fallen from 78 crores to about 55 crores. The company said that this year was shaped by geopolitical uncertainty, macroeconomic volatility, and sectoral challenges as well. They are cautiously optimistic, but there could be some red on that stock today. Brainbees, on the other hand, the revenues grew well, 15.8%, but the EBITDA, the reported EBITDA was down 52% and close to around 15 crores versus 33 crores. But if you add back the other income and the one-off expenses, as the company has claimed, the adjusted EBITDA has actually grown by about 20%. So we'll have to monitor how the street takes, that. The India business is doing well. India business has shown a revenue growth of 11.5% and EBITDA growth of 17.5%. The international business, that continues to face some challenges. Even though there has been a revenue growth of 11%, the losses continue to widen. And Global Bees as well, where the revenue has grown 33%, the losses have widened from 25 crores to 23 crores. So see some red on Global Bees or Brainbees.
Okay, all right. Thanks a lot, Mangalam, for giving us details on both those two stocks. So we'll keep a track on that as well. But let's wind this down with Vamakshi, who's here to tell us about Schneider Electric. Morning, Vama.
Good morning, Nigel. The company had a good run this time around. When you look at the revenue, that saw an uptick of almost 24%. Revenue has come in at 587 crores. And in fact, this is the strongest year-on-year growth as far as revenue is concerned since Q3 of FY24. And keep in mind that the revenues have managed to stay close to that 600 crore quarterly run rate, over the last couple of quarters. When you look at the EBITDA, that has come in at 87 crores. While this is a sharp sharply low as compared to third quarter. Third quarter, of course, was exceptionally well for the company. But, they managed to maintain that run rate of around 80 odd crores. EBITDA margins too have come off both on a year-on-year basis as well as sequentially to 14.8%. But nevertheless, they do remain healthy. When you look at the net profit, though, that has, when you compare it to quarter 4 of FY24, it's seeing a very sharp uptick. The net profit has come in at 55 crores, and that is because in the base quarter, that is in the same quarter last year, there was some tax-related adjustments. Now, apart from this, the company has announced capex. They are enhancing capacity both at their Vadodara plant in switchgears and at their Kolkata plant in breakers. They are looking at an investment of somewhere around 200 crores, out of which 110 crores will be for Vadodara and 91 crores for Kolkata. This will be financed with a mix of internal accruals and debt, and they are expecting some good demand to come through, which is why they're making the capex. Overall, when you look at the numbers, I would say a good set, going with the green for Schneider.
All right, got that, Vamakshi. Thank you very much. So green for Schneider. On to Ekta once again. Shilpa Medicare. Ekta, tell us, how does it look?
Well, good numbers. Revenue was up around 13% in terms of the revenue. The profit was below estimates, but there was an exceptional this time round. The API business, the company says that the order book is healthy. It was a bit sluggish. Formulations, new product launches drove the growth there. But the major milestone, and that's the reason that you saw the stock higher in yesterday's trading session, is the out-licensing of its flagship product, which is the recombinant human albumin for EU, with a commercialization in partnership with Orion Corporation. So that's the reason you saw the stock much higher, because it's their flagship product. And that's probably the reason you could probably see follow-up buying today.
Okay, well, Ekta, thank you very much for that. Shilpa, of course, has been has come up very sharply from 600 to almost 900 kind of levels, very fast. Let's talk about Electra Green Tech now. Hormuz is here with the news flow around this one. Hormuz, take it away.
Morning, Prashant. And negative developments coming in around Electra Green Tech, because the Maharashtra Transport Minister Pratap Sarnaik yesterday wrote on his social media handle on X that he has instructed officials to cancel the electric bus order that was given to the company. Of course, he did not explicitly name the company, but it was for a 5,150 bus order for failure to adhering to delivery timelines. And he also mentioned that the company was also given a revised timeline to supply 1,000 buses by the 22nd of May, which has not happened, and the company has failed to deliver even a single bus during this period. Also, of course, there is no official announcement from the company's end as well, so we need to keep an eye out on that. By the way, back in July of 2023 is when Electra Green Tech was awarded this order in consortium with Evi Trans for 5150 buses, which was valued at close to 10,000 crore rupees for a 12-year period. And Levy was supposed to procure the buses from Electra and deliver them over the next 24 months, which is by July of this year, and which has not happened, and as a result of which the contract has been ordered to be cancelled. And between July of 23 to February of 24, the stock of Electra Green Tech had more than doubled in value, and since then the stock has fallen almost 40% from its peak. So a negative development for Electra. Expect the stock to open in the red.
All right, Hormaz, got it. That's also on our list then. Thank you for that. Let's quickly recap the list of top stocks to watch then. The ones that have positive news flow are PG Electroplast, Aurobindo Pharma, Schneider Electric, and Shilpa Medicare. So just 4 names on the green side today. More on the downside. Let's recap them. Interglobe Aviation, Sagility, KC International, Brainbee Solution, Blue Dart, and Electra Green Tech. Okay, that's the equity list for the morning. Let's now take stock of what's happening with the commodity markets as well. We have Manisha Gupta joining in with the latest. Good morning, Manisha.
Morning, and thank you for that, Surbi. I'll start with the crude oil prices, where we have seen it holding gains ahead of the OPEC and allies meeting. That is on 31st of May, with an expectation that you would be looking at increase in production. But on the other side, we're looking at some support coming in as U.S. extended deadline for reciprocal tariffs of 50% on European Union. Also, U.S. president saying that they're considering sanctions on Russia seems to be adding some premium. And then the U.S. Operating oil rigs have declined by 8 rigs, and this is the lowest since November 2021, also supportive for the prices. So while crude oil prices is trading on a firmer note, we've seen gold prices slip after the U.S. extending EU tariffs to July 9. But gold seems to be taking a lot of support from the fact that the U.S. budget deficit is widening. The geopolitical tensions in Middle East and Ukraine just about continue. Investors also are waiting for the latest FOMC minutes. Well, that gets released tomorrow. But then the dollar index also trading at a one-month lows. Russia's largest aerial attack so far on Ukraine also seems to be adding some premium to the market. And most importantly, there was a Citi report yesterday which says that they have revised their gold target higher to 3,500 yet again. And they expect the gold prices to trade within 3,100 to 3,500. So clearly keeping it on the higher side and absolutely above $3,000.
All right, Manisha, thank you very much for that. So that's gold in focus. We'll take a quick commercial break here. We're going to come back and focus on stocks with Amnish Agarwal of PL Capital. So some fundamental stock conversation coming up.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's welcome Amnish Agarwal, Director Institutional Research at PL Capital, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, it's raining blocks. Now we know why the mutual fund industry is sitting on a lot of cash, which is the highest that we've ever seen as a percentage or even in absolute terms, at around 7% or thereabouts. And in absolute terms, it's more than 2 lakh crore. That said, what's your view on a couple of these larger names? Like Interglobe Aviation, we understand the promoter entity wanted to sell some stake. Now, source-based information that's coming in is indicating that actually the promoter entity is upsizing the size of the block. But that's been a stock that's, any kind of supply has been gobbled. Your view on the stock?
See, hi Nigel. Interglobe Aviation actually has been doing quite well. If you look at, say, particularly a few quarters, the numbers have been good. It is operating at, say, around 86% utilization, and now the crude prices are also benign. So that is also going to benefit. And moreover, the kind of market share it is having in the Indian market, which is one of the fastest growing market globally, that makes Interglobe Aviation currently sitting in a very sweet spot, at least in the near to medium term is concerned. Now, I think the promoters have been selling the stake, and it is something which is not new. But every time I think the stock is being lapped up by institutions. If you look at last couple of years, the stock has also got re-rated. It used to earlier trade at 6 to 7 times EV to EBITDA, but now that has gone into a double digit of around, say, 11 times odd. But looking at the prospects of travel, tourism, and the aviation sector in India over the medium term, we remain constructive on this name.
And SpiceJet doesn't deserve a look in. Interglobe is what you're positive on, but you would not look at SpiceJet?
You see, SpiceJet is more like, time and again, it has been raising the funding, but somehow the expected turnaround is not happening. And that is where then the investors' patience also goes out. Now, given the prospects, one would have expected that SpiceJet should turn around at some point of time, but somehow I think they are not able to gobble up the kind of efficiencies which are requiring. So I think it is better to stay with the leader rather than to continue, you can say, expecting a turnaround in a name which has not happened in the near to medium term.
Okay. All right. Amnish, got that point. Stay on. We have lots of other questions for you as well. But earnings season, so let's quickly get to a management conversation as well. KC International is the company on the radar right now. The company reported a pretty good performance for the fourth quarter. It was a better end to what was otherwise, let's say, a muted year. Perhaps one can call it that. The company, of course, is talking about its order book growing forward, going ahead. Let's discuss this. We have Mr. Vimal Kejriwal, MD and CEO at KC International, joining in. Great to have you back on the show, sir. Good to be talking again. So Q4 ends on a high. Like I said, the year otherwise, the market is obviously saying that you've not been able to meet your lower guidance, whether it's on, the margin. I think you'd guided for margins 7 to 7.5%. You're at the lower end as the year ends, about 7. And top line growth 12 to 14%, but you did about 10 odd %. So now, sir, let's talk about this, because the commentary, what we've got from the press release, etc., is looking very strong. You're talking about the T&D segment doing better, money being released by state government, so maybe the water business starts doing better. rail, etc. So let's talk about the top line growth and the order book growth that you see ahead this year.
Morning, Surbhi. Thanks for having me. I think I'll just take a minute on your earlier comment. Basically, after the Q3, we had down our margins to 7%. And growth, yes, I think the basic issue which we have faced in Q4 has been the shortfall in the payments and water. We were expecting that the water business would, the payments would be released by the governments and we would be able to, sort of execute those orders. We have now started receiving monies and we have started paying, started executing the projects. So that has led to a slightly lower growth. Instead of 12, we have ended up at 11%, and for the year 10%, etc. And similar margins also at the end of Q3, we had switched over to 7 because of this only. Water is a more profitable business. So I think that's where the margins are and the top line is slightly lower. Although to me, they are a record high for the company as a whole.
But FY26 now, sir, that's fair. But I mean, like I said, it's ended on a very optimistic note the previous year. FY26, now let's talk about the order book. There's a large L1 pipeline. How much do you see coming to you? And of course, revenue.
Just one thing, Mr. Kejriwal, sorry, just to finish that point on margins. So where do you see margins at FY26?
So Q4, we ended up at 7.8. And for next year, we have been now talking about 8 to 8.5%.
Which is 8 to 8.5% this year, FY26, the financial year we're in.
FY26, yes.
Okay. Glad to clarify that. Go on, sir. To the point of orders, L1, etc., what Surbhi was asking.
Yeah, sure. So I think this year we had an order intake of slightly lesser than 25,000 crores, of which almost more than 70% was in T&D. Almost 18,000 crores came in from T&D, rest coming from civil and railways and cables, etc. We have an order book plus L1 right now of around 40,000 crores. This year already we have declared orders of more than 2,000. So with that, I don't think we are looking at a growth which would be less than 15% for the year. Margins I have already talked about.
15% revenue growth for this year. Got that, sir. We've noted that. Also, this improvement in the margin profile from 7.8% in fourth quarter, you're talking about almost 100 basis points improvement by the time the full year ends, this current year. What will drive it? Will the mix change? Give us a little more color on both the revenue growth and the margin growth. What will drive it?
So clearly the mix will change slightly with the railways coming down. Last year also railways came down from 3,000 crores to 2,000 crores and we expect it to continue at 2,000 crores, whereas our overall top line will grow by 15%. Transmission, as I said, was 70% of our order intake, and I think it's around 60% of our order book. So we expect that within the businesses, the revenue share of transmission will grow up, and I think it's more profitable than all other businesses. So that's one basic reason. Second is we expect that the civil margins also will start, inching towards 8% or something. So both these factors would help us in improving the margins. I think the other thing which we need to keep in mind is that our interest costs have been coming down. For the quarter, we were at 2.5% of the revenue. So when you look at the PBT and PAT, our PBT and PAT have grown by more than 60%. So I think more than EBITDA, we start looking at that. There we expect a much higher growth.
Okay, all right. Hi, Mr. Kejriwal. I take that point on board. In fact, your net working capital days as well has come down by around 12 days. Will it hover around this vicinity of around 120 days or do you want to guide for a higher number? If you could give us some clarity on that front. Yes. And as you said, your net debt as well, I'm looking at it, including acceptances, that's come down, I think, from around 5,000 crores, it's come down to around 4,500 crores. Does it stabilize at these numbers? Working capital and net debt. Please go ahead.
So Nigel, on the working capital, from December, we're down by 1,000 crores. From last March, we're down by 500 crores. And we expect it to go down further by another 500 crores this year, despite the 15% growth in the top line, which we are talking about. So I think we are very comfortable with what's happening on the net debt side and on the interest side. In fact, our interest for the year is at 3% of revenue, 2.5% for the quarter. And we are hoping that we'll be able to maintain 2.5% for the whole year.
Okay, all right. 2.5% interest cost as a percentage of sales. And the working capital days, around 120 days?
No, it will come down by at least 10 days.
Another 10 days, so around 110 days, 110, 112 days is what we could work with. Got that, Mr. Kejriwal. Just a quick question. There is these legacy issues on a couple of aspects. If I look at water, if I look at railways as well, do you think bulk of it now is behind us and things will only get better from here on?
So water is not a legacy issue. There were new orders which we got 2 years back. We still have an order book of almost 2,000 crores. profitable orders. I think it's just waiting for funding from the government. We have orders in 2 states, MP and Orissa. Funding has started flowing in. So I think hopefully this year we are targeting almost, I'll say, 12 to 1500 crores of revenue from water. So water is not a worry in the sense of profitability. It's been a worry in terms of revenue, etc. Railways has been a problem, I think, but we are now almost at the end of the tunnel. We have closed most of the orders, and hopefully we should be able to get out of all those issues by this year end.
Okay, and TND side, it seems you all have got quite a lot of strength. According to your analysis, in India at least, the business has looked up. That is one part of the business has looked up. Have you gained market share?
I don't think I'll say we have gained market share, but what is happening is that the quality of the order intake and the margins are going up because the order sizes are going up. So, and they are becoming much more complex. So I'll not say market share, but I think overall the top line and the margins have grown.
Mr. Kejriwal, nice touch there on railways, end of the tunnel or light at the end of the tunnel. Just a quick point in terms of water. Will you, like railways, will you go slow now on railways? You've gone slow. You've told us that over the last many quarters we've spoken. Will you do the same with water if new orders come? Because this is all B2G, right? So the government has to release payment, and that can go sometimes. It can be out of whack.
So Prashant, water was never a problem. I will tell you honestly, till the last year, till before the elections, parliamentary elections, we were getting water. I think water payment was one of the best we had from government. You raise a bill on 27th and 31st, you used to get the payment. I think somewhere something happened and the allocation to water went down. So what we are looking at is a state by state, like today MP is paying reasonably well. So to depend upon which state and what the payment track record is, and then we will decide. We are not aggressive on it, let me put it this way. But we are looking at, with the experience we have gained, we are looking at taking up some projects on the international side.
I'm glad you mentioned that, sir. I was just coming to the international.
One thing.
Okay.
What exactly do you do, Mr. Kejriwal, with in terms of the segment, water?
So basically, we are in what they call Jal Se Nal Tak. So it's basically putting up intake wells, filtering the water, and taking them to the end user.
This must be a pretty. It's obviously very large allocations in the budget, flagship program, etc. Could you give us a sense of how? I mean, every year, what's the amount spent really?
I think the last budget allocation was around 65 or 70,000 crores. I think the problem, Prashant, what is happening is typically 50% comes from the state, 50% comes from the center. I think that's where the mismatch happens. Sort of who will fund the money first? That's where I think the problem is happening. It's getting sorted out. It was sorted out earlier. Somewhere last year it got into trouble. Hopefully it should get resolved.
Got that. You also mentioned that you will be looking at water projects in the international markets. And that was my question. Overall, sir, finally give us a color on the mix between, the share of India revenue, overseas revenue, across businesses. I mean, TND, you've been always very big and bullish on the Middle East markets. What's happening there? This year, how are you expecting the international business to perform? And of course, water, like you just mentioned.
So TND typically is around 70% of our TND business is from international and 30% is from India. But overall, if you look at the overall ratio, it's the other way around because we still don't do railways and civil and all others outside. So if you look at the overall level, it would be 70 India, 30 international. But TND is the other way around. That's the way the ratios are. And I think what is happening on the TND side, our major areas continue to be Middle East, whether it is UAE, whether it's Saudi, Oman, Kuwait. I think we are doing very well. We have a large order book in those areas.
All right, Mr. Kejriwal, we'll leave it there, sir. Thank you very much for coming on first here on CNBC-TV18 and speaking to us about FY26 across business segments. Good luck, sir. We'll take a quick commercial break here. We're going to come back. Technical trades and focus. Sudarshan Sukhani and Chandan Taparia are going to be with us with what they want you to do in terms of specific trades. Stay tuned. Okay, welcome back. 9 minutes to go for the market pre-open to kick off. And let's get in Sudarshan Sukhani and Chandan Taparia, who are with us with what they want you to do in terms of specific trades. Gentlemen, great to have both of you here. Sudarshan, let's start with you. It's a flattish start, and in that sense, a neutral, clean start, neither here nor there. What's the path of least resistance, Sudarshan? Higher?
Yeah, good morning. Well, the Nifty is at a very interesting place. It's been moving in a trading range between, let's say, 24,500 and 25,000. Now it's pushing against that 25,000 resistance. If and when it crosses that resistance, we can expect a 400 to 500 point rally in the Nifty. Now, Prashant, it's anybody's guess. I mean, suddenly something can happen. But given the current tendency of the market to move higher, I would expect a breakout on the upside and a reasonable move eventually towards 25,500. With this view, my suggestion is if you are long, stay long, expect some intraday volatility. That is part of the process. You can't avoid it. If you are not long, you should be long if the Nifty is trading above 25,000 for any decent intraday period of time. So be on the long side of the market. A breakout could see very interesting levels on the higher side.
Okay, be on the long side. That's the call that's coming in from Sudarshan. Let's go across to Chandan. Chandan, what about you?
Good morning, Nigel. Thanks for having me. So market setup is positive and the levels are gradually shifting higher. We have noticed that higher base is clearly visible and the put call ratio is holding well above 1 marks. We have noticed that India VIX has seen surge because the call unwinding started to happen at 25,000 strike and the fresh put writing is being placed at 25,000, which is giving an early sign that market has potential to hold much higher than 25,000 marks. We are in monthly expiry and expiry on expiry basis, the Nifty index is up by around 3% and volume weightage average for the entire series is at 24,600 and we are 400 points higher than the VWAP, which clearly indicates that bulls are driving and they are having the grip on the market, and because of that, till it holds about 24,850, we are expecting this rally to extend towards 25,200 to 25,400. So suggestion is buy any small decline or play the breakout. Market has potential to rally by 300 to 500 ahead of its monthly expiry led by short covering and the call unwinding and the put writing activities.
Okay, both sounding fairly optimistic on prospects of the Nifty. Well, Sudarshan, you go first on the stock calls. What all is on your radar?
Well, again, it's a mix of large caps, small caps, mid caps, but all on the buy side. Nestle is a buying opportunity. I've talked about how FMCG is giving buy signals repeatedly. Stop under 2,400. Hind Unilever, Hindustan Lever is also a buy with a stop under 2344. Manappuram from the NBFC space looks interesting, worth buying into, a stop under 225. And Torrent Power is a buy with a stop under 1,394. Wait for small dips and go long.
I've got that. Chandan, what about you?
Yeah, so I have two names from Capital Goods, L&T and BHEL, and one from the pharma. So to start with L&T, the stock has given a breakout from its pole and flag pattern on the lower time frame. In fact, holding well, given a consolidation breakout of last 10 trading session, making higher highs, higher lows on the weekly chart, which indicates overall bullish sentiment. We have seen surge in the trading volume as well as the open interest activity, which suggests momentum could continue. So with support of 3570, we are expecting L&T to head towards 3,800 marks. Talking about BHEL, trend is intact. Breakout is already visible. The stock has managed to hold about 255. Open interest activity are indicating bullish strength. So with support of 256, we are expecting a rally towards 273. Last trading area, that is buy on divi slip. We have seen a major breakout in the counter. It has managed to give a decisive hold above 6,600 marks, and that level could act as an immediate support to drive the next leg of rally. So one can buy divi slip with support of 6,600, and this has potential to rally towards 7,000 plus marks.
All right, got that. Thank you very much, Chandan. And Sudarshan, appreciate both of you coming on with those trading ideas. More soon, a little later. 4 minutes away from the pre-open session. Let's just quickly take a quick commercial break here. We're going to be back with, of course, rates. Vishal Manchand of Systematics Group will also be with us to talk about the pharmaceutical space, Divi's, Aurobindo, and more. Stay tuned.
Welcome back. Well, Amnish Agarwal is still with us. Amnish, we heard the discussion we had with KEC International. Last year was a bit of a softish year, though for this year they're guiding that things will be better. Revenue growth in mid-teens, margins improving by around 50 basis points, and the net working capital days, after improving by around 12 days, will improve by another 10 days, which means that, that overall borrowing as well remains under check. What's your view on the stock?
You see, we are constructive. We have an accumulate rating on this name. And the main thing is last year, many of the businesses were not doing well. But I think the growth there is expected to revive. That is one. The second is that in this industry in particular, what is more important is how you manage the working capital. And the improvement in the working capital particularly is positive because free cash generation in some of these TLT companies and some of the other businesses which they are conducting. So that is something which is very important. So I think looking at these two aspects, although the numbers have been, I would say, not that great, but the future is reasonably optimistic.
All right. Amnish, what about Eternal, erstwhile Zomato? What's the view out there? This is a big week actually because there are two rebalances that will take place. FTSE takes place today and we have MSCI that takes place on Friday. The stock is at around 225. I think the rebalance announcement with regard to FTSE was a bit of a shock. That's why the stock ended lower. However, the stock, there is a big DII holding in the company and there are a lot of active mutual funds that hold the stock which are sitting on a lot of cash, which could support the stock going ahead. Your view at around 225 rupees?
See, fundamentally, it is in some sort of, I would say, range-bound situation because the industry is going through lots of ups and downs. There is immense competition which has cropped up more on the quick commerce side in the past 2-3 quarters. And looking at the kind of, you can say, players which are now entering this space, expanding, I think there is very limited visibility as far as quick commerce is concerned, at least for the near term. Now, the current softening of the stock price has happened more because of the technical factor, because the foreign holding in the company is now below 50%, so it has gone out of some indices, etc. So I believe that while there could be some, you can say, interest to lap up the stock at the current correction, but at the same time, if you look at say next 2-3 quarters, I think numbers are not going to be anything exciting, at least in the near to medium term. While in the long term, I think we need to be clear that you can say that things could turn out to be better, but at least in the near to medium term, I think the stock should be range bound between say maybe 200, 230, 240 levels.
Got that. By the way, let's just look at BEML if we can. Was a big 16-17% gainer yesterday by close. Let's see where that is starting. About 0.5% higher. A few of these names, right? NetWeb was a big winner, 6-7%. These have all been running up lately. Phenolix Pipe was another one. Actually, a lot of the pipe makers, Astral, Phenolix, etc., they all were higher in trade yesterday. I think Nimesh was talking about that on D Street Chatter yesterday. Shilpa Medicare, and I think we'll talk about Shilpa with our pharma analyst in a bit from now. Gillette reported numbers during the closing last hour. Gillette will come up on your screen. Again, it ended about 8-9% higher. Camlin Fine was a stock which there were I think 2 brokerage notes. We highlighted this yesterday. Camlin Fine 16% higher in terms of where it closed. And IT Cementation. Another one is Cosmo First. Completely bombed out name, but just look at what has happened over the last, I think, 5, 6, 7 trading sessions now. Cosmo First has basically done 10% on trot for the last several sessions. So many names here. Anything strikes a chord, Amnish? Anything you track out of the names I mentioned?
Yeah, you see, BML, which you talked about, is one name which we tracked. And this company actually is sitting on a lot of orders. And the problem last year was that the execution of the orders was not there. Now, if the execution comes into play, and the fact that this year, I think the execution more from the, you can say, armed forces will also be better. I think this is one stock which one, you can say, need to watch out for.
Need to watch out for BEML in that sense. Balkrishna Industries, any thoughts? I mean, was down sharply after numbers. Amnish?
No questions.
Okay, no real comment. Anything you like out of the hospital space? Again, I mean, it's a space which has done very well. The latest addition to the entire move higher has been HCG, the cancer specialty hospital. After the financial investor changed hands, I mean, the stock's done very well. Yesterday was down, though, a little bit of profit booking. What's your pick out of the space?
This space has been doing very well. It's more like, you can say, one of the very structural themes which we have been pushing from last couple of years at least. Because here you can see the margins of most of the players are improving. ARPOB is good, and particularly this HCG, because the KKR I think now has acquired stake in the company, and there's a lot of scope to improve the efficiencies over there. So that is one name which might struck chord in the coming times. But if you look at, say, among the existing players, I think Max is a very structural play, good margins, good profitability, a lot of capacity which is coming in terms of, say, you can say the bad addition which is happening over there. In addition to it, we are also positive on Aster DM, because Aster is also again undergoing consolidation. Once Quality Care gets subsumed into this will be the third largest player, trades at say 20-25% to some of the other large names. So I think these are the two stocks, and then your Rainbow is also there. So I think the space looks very exciting, and it is only, I would say, where the efficiency comes, the growth comes, and I think all the good stocks eventually, wherever the valuation scopes are there, they can trade anywhere between 30, 23, 25 times EBITDA. And one can continue, you can say, holding some of these names for the, I would say, next 2-3 years, because still there's a lot of room to make money.
Okay. All right, Amnish, got that point. Thank you very much for being with us. Great to get all the perspective from you on those stocks that we've discussed. Well, let's now put the spotlight on the pharma space. And as we do that, I'm just quickly taking stock of the Nifty in the pre-open as well. Pre-open's just started, so let's see. Right now, it's showing a 90-point cut, but it should settle. This is what we have at first glance at this point in time. Some of the stocks where the block action is expected, they're in focus. Agility, for instance, down about 5% in pre-open. The Interglobe and the others will come up as well. Some of the pharma stocks are actually doing very well in the pre-open space. Dr. Reddy's, for instance, about 0.7% higher. Sun Pharma, Cipla. Pharma names are the green space in the market today. So good time to bring in our next guest. Of course, we've had a slew of earnings coming in as well. Aurobindo reported, Sun Pharma came out just a few weeks back. Divi's has signed a pact for a supply of long-term agreement with the global pharma company. So talk about all these developments. Vishal Manchanda, who analyzes this sector at Systematics Group, is with us. Vishal, thanks very much for joining in. Let me start with the broad question first. So the earnings season has been very mixed. I remember Sun Pharma fell quite a bit the day the numbers came, and then it recovered because the US performance was subpar. And the global specialty business also, I think numbers were missing expectations in the fourth quarter, but the commentary seemed to be better. You tell us, what are the key hits for you at the end of Q4?
I think broadly, if I look at the sector, we haven't seen a very large outperformance across companies. Broadly, I think, so what's not gone right for the sector is probably the US piece has not shaped up the way we would have expected during the quarter. India was expected to grow between 8 to 12%. And I think now a significant majority of the companies are on the lower end of the growth range rather than the upper end of the growth range. So I think a very few companies are able to deliver double-digit growth in Indian pharma space. So I think there is a slowdown here in the IPM category. US probably is a bit slow because Revlimid didn't shape up the way we were expecting for the quarter. It's because there is some pricing pressure that's happened on the product. And we know that it's a large contributor to earnings. So overall, I think it's more of the pharma space hasn't done well as per expectations.
Got your point. I'm just going through some of the calls that you have, Vishal. You still have a buy on Sun Pharma, and then you have a hold on lots of stocks in Doco, Zydus Life. I think Mankind is also a hold. Let's talk about the big blue chip pharma names first. You like Sun Pharma? Do you like anything else? What would you advise? What's a buy? Looking at the next 12 months at least.
So I think I would look at Sun and Cipla as structural stories in the sector, while Sun being a better, Sun being kind of longer term, there is more visibility around Sun in terms of the medium to long term growth. And that's largely because of the specialty platform that they've been able to build and kind of differentiate themselves from the other pharma companies in the large cap space. Cipla, probably I prefer Cipla because of the lower US dependence. So they have only 30% of sales coming from the US generics. And we also see a pipeline visibility that's there. So the US earnings probably can still grow from where they are. While for the sector, I think the earnings contribution from the US is on a high base, and probably we'll probably be seeing the earnings from US being either low single digit growth or low single digit decline. And I think I would rather look at a low single digit decline. That's where I am on the.
Got it. Vishal, let's talk about a few other individual names, right? Shilpa Medicare, big run up lately. Off the lows, there was news flow end of last week. How do you assess prospects for this one and valuations as well?
So I think Shilpa is one company. We'll have to kind of, there are so many triggers out there, so many triggers in the form of product launches. And all of these product launches are differentiated. Probably they're the only ones for those products on the market. They are also building a very strong CDMO platform. They have relationship with large innovator companies. They'll soon be initiating commercial supplies for a breakthrough oncology API. I think there are 7 or 8 triggers on the product side, basically, that can kind of transform their earnings and EBITDA trajectory over the next 2-3 years. And I think the longer term growth trigger for Shilpa Medicare is their albumin initiative. So they're developing a recombinant version of albumin, which should shape their growth from FY28 and probably long term growth for the company. Only thing is, execution is something we'll have to wait and watch in the next 2 years, whether commercial execution happens the way we would want it to.
Okay. Another very small company, I don't know if you track it, is Panacea Biotech on the vaccine side.
Right.
Anything happening there? Because there's that hexavalent vaccine, right, which they developed, 6-in-1.
Yes.
And I think Serum was making that vaccine for them, and I think I don't know if there's been any cutback because UN, etc., were big buyers of that. At least there was stock of millions of doses which will be required. Anything latest here in that sense?
Yeah. I haven't come across any major development except that they are also doing a dengue vaccine, and we should see data maybe in the next 1 or 2 years on the dengue vaccine. I think if that clicks, that can be a game changer for Panacea Biotech. And as a company, I think they keep looking at niche opportunities, and I think they have capabilities. They have done things in the past which not many companies have been able to do.
In the small cap, 30-second answer, Vishal. In the small cap pharma space, what are your picks?
So like Orchid Pharma there.
Okay, Orchid. Got that. So next one, we'll focus our conversation on Orchid, Vishal. Thank you very much for joining us. Good speaking with you, and it's a pleasure having you here on CNBC-TV18. 9:10, 9:12 actually, so a little behind schedule. So let's get the calls out of the way. Sudarshan, what do you have?
Well, it's Manappuram. Consider buying Manappuram with a stop under 225.
Okay, Manappuram with a stop under 225, 230 at the end of the pre-open session, 9:12. Let's get the standout brokerage notes out of the way as well. Nimesh has been pouring through them. Nimesh, what do you have?
Hi, Prashant. So today's standout is on Varun Beverages. Interestingly, the stock has been under pressure of late on back of selling pressure and a bit of competition as well. But Goldman has put out a note. They have initiated coverage in the stock with a buy rating and a target price of 600. They believe that Varun Beverages, has multiple drivers for the stock to outperform from here on. In fact, they see a big market share gain as well in few fast segments like energy drink and hydration. The key concern for a lot of investors was the competition from Campa-Cola, but Goldman believes that their analysis suggests no big disruptive impact on Varun Beverages. In fact, they see a big opportunity in the international market where the South Africa business can turn around over the next 3-4 years, and the profitability is likely to go up according to the Goldman note. In fact, they expect the EBITDA margins to improve from 10% to 17% in the international business. The stock trades at 40 times, which is below the median, and hence initiating buy on Varun Beverages with a target price of 600 from Goldman Sachs.
Okay, Varun Beverages definitely on the radar. I'm just checking how it's doing as of now in the pre-open, about 2% higher. By the way, KEC is up about 3.5% as well after that management commentary, where it is sounding far more optimistic on FY26. But Nimesh, I'm looking at all these stocks, the blocks that you alerted us on. Okay. Anyway, just to talk about them, Sagility 5% lower, PG Electroplast 1.5% lower. At this point in time, and Interglobe is about 3% lower as well. These are the three big blocks that we're watching out for today.
Absolutely, and you know the look at the indices as well, right? I mean, I think we are starting slightly lower in terms of the open, 45 odd points lower on the Nifty. Yeah, I mean the blocks, of course, right there at the top of the list, really. Aurobindo is, I think, slightly lower as well. KEC, you know, you heard the guidance from the management earlier. By the way, KEC was one of the big winners yesterday. So it's up 3% again this morning, about $30 on it. There is Brainbee Solution, Blue Dart, some of the fourth quarter earnings, right? Schneider Electric is another one. And they'll come up on your screen as well. 1% down on this one. Blue Dart will come up. And then Schneider perhaps as well. Electra Green Tech is another smaller one. Maharashtra government has cancelled e-bus tender, and Hormuz was telling us about that. So all that in terms of specific stocks coming up, but we'll look at the indices as we begin this session right now. So 24,966 is where the Nifty is at, 0.14% lower. The Nifty Bank is down about 0.19. So it's mildly lower. Small cap index is up 0.1, and the mid cap index will come up on your screens. That is unchanged, almost unchanged. 57,040 on the Nifty small cap index is what you have. Just take a look at the Nifty heat map as it should come up on your screen next to give you a quick sense of where we are starting. So it should be pretty mixed. Actually, you know what, 4 or 5 names are higher and everything else is starting in the red. But I don't think there's any large move in any case. Eternal is down at one end of the spectrum. It was, of course, down 4-5% yesterday as well. By far the biggest loser of the Nifty. Surabhi.
Yeah, although the KC is the one that's really flying away, up 5.5%. Remember, they're talking about margins also going up to almost 8.5% this year with a 15% top line growth. That's on the mid-cap newsmaker side, but on the overall large-cap screen, it's a little bit of pharma. Dr. Reddy is actually not too much also. The Shriram Finance, which is on the upside. Market slipping, by the way. The market suddenly down 90 points. So it's getting a little volatile. The bias is negative. What's pulling it down? Let's take a look at it. Tech is definitely pulling things lower. Infosys, TCS, these are the stocks on the lower side. There's HDFC Bank, Reliance, Axis Bank, lots of the heavyweights lower. ITC is lower. 100 points down. Mid-cap index slightly negative. Bank Nifty is slightly lower as well. So it's turning out to be a bit of a weak start now. HDFC Bank also on the lower side. The thing is that there are no big counterweights on the upside. It's a bit of a full sell down. BEL, IndusInd Bank, Hindalco. That's it. Pharma's not really able to firefight. So for the time being, there's profit taking. I guess, Nigel, that's what one would also expect. Markets rallied. We touched that 25,000 psychological level yesterday. This morning on the large cap screen, some profit being taken.
Well, that's right. But the broader markets, actually, there are plenty of winners. Let's pull up a few actually up for you in the screen. Cosmo first continues its good run. You know, the street suspects there's going to be a shortage because one of the competitors had a fire at their unit. But the way the stock is moving, I don't know whether it's warranted to that extent. For this month, the stock is up close to around 80%. That's Cosmo first. Big up move is what we're seeing on that one. Electra Green Tech, because of that order cancellation, we have that stock that's down close to around 6%. BSE has come in for some mild profit taking. We're waiting by to hear about the final verdict with regard to who gets which expiry day. But for the time being, the stock is down close to 100%. Bajaj Healthcare from the broader markets, it's come in for some big profit taking. Came out with a set of numbers. The street has read it. That is a bit of a disappointing set of numbers. But that's down close to around 5%. That's one of the top losers. On the flip side, you have a few stocks that are gaining. Venus Remedies, the stock is up 10%. Bayer Crop, that stock as well is higher in trade today. It's up close to around 7%. So big move out there. Akums Drugs, that's the other one that in fact is sitting with solid gains in today's trading session. So big up move is what we're seeing even on that particular name. Akums Drugs now up close to around 5% as we speak. And I think KEC, the one that we spoke about earlier, that one is up close to around 4.5%. DAM Capital as well, by the way, the stock after hitting a low, I think, of around 210 rupees, it's bounced back 30% in this month. It's up close to around 3.5%, one of the top winners. Yes,
sorry, I missed whether you mentioned GE Vernova.
No.
Look at that stock, 9% again today after a 10% circuit yesterday. Ooh. That's a big move post numbers.
I mean, rockets all across, right? And lots and lots of big gains. So 22.55 on that one coming through. By the way, defense, I'm seeing some shade of defense names all coming back together. BEML is up 3, Garden Reach is up 3, Bharat Defense is up 3. I think Apollo Micro is up 3.5%. Yeah, I think there is a shade of defense which is doing well. And this is, by the way, all within the top 10 volume-led gains, which is coming through at this point in time. You know, Nigel mentioned Cosmo first. I've been looking at this last few days. Bombed out name, and so many people I know who've held on to that name and sort of sold in frustration. And suddenly, I think there's some shortage of BOPET. And because of a fire at a competitor, I think that's essentially what the chatter is about. We'll try and actually reach out to the management because this is, from 550 to 1100 very, very quickly in basically 6 or 7 trading sessions. It's just been, one way in that sense. Acom's drug is up about 4% or so, 606. And I think we mentioned Bayer, which is up about 10% or so as well. By the way, market breadth is, evenly kind of spread out. Equal number of gainers and losers as well. More names in a bit from now. Well, let's talk about markets in some more detail. Sridhar Sivaram is Investment Director at Enam Holdings, and he's with us here in our studios. Sridhar, great to have you with us here. Thank you very much. It's been a while. So good to speak with you. Where do you and your team stand, Sridhar, now with the markets come up so fast, vigorously and furiously?
So our broad view is that this is a year where we're going to see these ups and downs. It's going to be more a sideways. It could be range bound. So when the markets go up, you'll feel like you've missed out, and then you'll get an opportunity when markets come off. And there'll be so many news flows that we are going to get. We already got so much, and we are going to get so much more. And I think more globally than domestically. So if you ask me, you have to look at bond yields in the US, in Japan. I mean, when were we talking about bond yields in equity markets? But that's the reality, that you have to watch them very carefully. They can have a massive impact on global equity markets. So I would say the global macro is looking a bit more questionable. Surprisingly, Indian macro is looking very good.
Very, very good. And it's happening also fast, right? By the time you get ready to do something in one direction, it's done. I mean, and then you're looking. So it's better at the top end now, Sridhar, you think? This range that you're talking about, up and down.
So it's very difficult, Prashant, to say what is the top end, what is the bottom end. It's better to look at stocks that you like and figure out a price which is you're more comfortable with. At least for us, it's easier that way because we don't have a benchmark, we don't have a competition. So it's easier for me to say all this. I'm sure it's not the same for others. Where if you're getting so much cash into your fund, you don't have a choice but to,
So when you were talking about a range, you were talking about indices.
Yeah, in the index. But then index is composition of where the stock prices are, right? Correct. So so you'd look at the index and you feel there's a range. I mean, there's only that much the market can go up. If earnings don't support, plus you need global macro to support. You can't have that India goes one way and the rest of the world doesn't support.
So let me ask the same question slightly differently. It started to get a drift. Simple question is, minus the flows, whether local or global, X of the flows, do you get the sense when you hear corporate commentary, when you look at the earnings profile, when you look at on-ground visibility, do you get the sense that this market at a broad level has a lot more steam to go higher? No.
Simple answer.
Simple answer is no.
Yeah.
So, okay, let's drill down a little deeper then. So for a market like this, which is not going to have this overall gush of, momentum, how should one approach it? Which are the pockets to look at? What should investors be doing over the next 12 months?
I'll tell you what is good for the market, how I see the market in the, say, next 9 months, 12 months. So we are entering a phase, I would say a golden phase of inflation. I mean, next 9 months, we could see average of 2.5–3% inflation.
In India?
In India, I'm saying.
Whoa.
RBI is going to significantly bring down the inflation forecast when they announce their policy on June 5th. When they announce, obviously, there'll be more credibility, but we are entering a phase. So what will happen is we could see a 50 basis points rate cut in June itself. I mean, these are, my and our predictions. We could go wrong, but based on the numbers that we are seeing, this is how we are seeing. We need support globally. If Fed doesn't cut interest rates, there's only that much that India can cut. if we get support globally, we could see 100 basis points of rate cut, which basically means that we are currently seeing a slowdown in consumption. We're seeing a slowdown in credit growth. All of that could change because with the lower interest rates, imagine if mortgage rates were to come back to the heydays of 7.5%, demand for real estate can go up. So I think a lot of things will fall into place. So currently we have an issue where demand for credit is poor, consumption is poor. But if these numbers were to play out over the next 9 months, and we'll know a lot by June 5th when RBI will also come out and give their numbers.
You think it's warranted? I mean that's a really very clear call that you're taking. 50 basis points in June, maybe 100 basis points over the course of the next 12 months. You think those kind of rate cuts are warranted and you're expecting them?
I think it is warranted because our growth is slow and we are not going to get these type of inflation numbers. I mean, the last time we saw such inflation numbers was, I think, in 2018-19. We could see some months inflation below 2%. So we are actually entering a phase which is very good for us.
Golden phase.
Yeah, I mean, if the RBI, and we have a governor now who's pro-business, also pro-liquidity, because that was the other concern. So if you see, some experts believe that the 25 basis points rate cut has already happened because that's where the call rates are. They are below the repo rates. So we could see very proactive measures from the Reserve Bank backed by very solid data. So if the inflation is below 3%, there's no reason for you not to cut rates. The question is, what is the differential that you're comfortable between our 10-year and the US 10-year? We're already at the lowest that we've seen in the last 15 years. So I think that's the challenge. So if you ask me, as I said, the global macro is looking challenging. Indian macro is looking extremely good. We could be in a golden phase, at least for the next 9 months in terms of inflation, which is what people look at. I mean, and inflation directly affects stock markets. If this plays out well, then what I'm saying that in the next 6 months or 9 months could be a consolidation phase, which can then build into the next bull market. I mean, earnings have to follow through. So you take baby steps right now and build your portfolio for what comes in the next 9 months.
All right. What about the breadth of the market? You know, the small cap in universe had gone bonkers actually earlier, you know, stocks flying around, and then it cooled off. However, we have seen a lot of the small caps, you know, broader market stocks may not be best in quality, but they have bounced back. How much of that froth that was there in the market, how much of that has cleared out? Or do you believe there's still a lot in the market that needs to clear out?
I think a lot has cleared out. I mean, the frenzy that we had seen sometime, late last year, a lot of that has cleared out. Obviously, there'll be some pockets here and there which will still have some froth, but I think a large part is cleared out. If earnings follow through, I mean, for small caps, you need strong earnings. You don't pay 30, 40 multiple if they don't have, similar earnings growth.
Yeah.
And if earnings don't catch up, then they will correct on their own. Plus, the liquidity has been very strong for them. I think eventually everything boils down to earnings.
All right.
So if your strong earnings and the visibility is good, they can sustain. And we've seen, many darlings of the market collapse because of poor earnings.
Okay.
So I think that's how I would put it. It's becoming a very stock-specific, bottom-up market. If you ask me sectors, I'll really struggle because you can't really find sector winners right now, but you will find a lot of stock-specific opportunities.
All right, what are we talking about darling? The darling has been gold, right? And we have to talk about that. What's the probability we see a big pullback on gold from here on? And I know what you're going to say with regard to you need to buy gold at every level in a staggered manner.
No, so actually, first I want to clarify some of the myths on gold, because I've seen, a lot of people are talking about gold that, now 20-year, 15-year gold is matching the sensex returns. And the general, commentary I heard here is that it's because of the last 2 years that the gold is matching it. People forget, because there's a recency bias, that the best period for gold was 2004 to 2011. There was a 7-year period when gold gave a CAGR of 25%, when sensex gave a CAGR during the same period for 12%. So that was the best period of gold. Then gold has had continuous returns, small, but it has continued. And then we had last 2 years, which have been very good. I think the same will happen, that when you get strong returns in gold for a few years, you'll see some moderation in returns. We've had a 50% jump if you take the last 1 year. Can't have 50% returns in gold every year. So it'll moderate for a while, but I'm still very bullish on gold, only because of the fact that if central banks across the world are having a very loose monetary policy, QE in some form or the other is continuing, we'll see that reflection in either Bitcoin or gold. I don't understand Bitcoin, so I prefer gold.
I take your advice very seriously. As a percentage of your portfolio, how much would you recommend?
10% is my view. Different people will have different views.
I think Nigel is more. Huh?
I've been following, yes, Sridhar. I mean, for the last few years, my daughter's 4.5, 5. So every year, a little bit, and I always say, thank you, sir.
Sridhar, come back to stocks. And,
sure.
And what's the... Give us some...
Yeah, so you mentioned one of the stocks today which was hitting upper circuits. We are very bullish on the power equipment space. So if you see, it's a global theme actually. So if you see, India will possibly double its solar and possibly double its wind. We may add 60, 70 gigawatts of even thermal. When you get so much of power which comes into the system, it has to be evacuated. So I think the entire value chain will play out. Some of the stocks are very expensive, so you have to play out, you have to figure out which one you prefer. But you get a lot of opportunities. In bad markets, you get some of these stocks.
We had one opportunity. I was just looking at Hitachi,
Yes.
for example.
Yeah, you had...
From 16,000, went down to 9,000.
You look at the entire power equipment space, they collapsed sometime in March.
Correct.
You could have bought any of them 30-40% below where it is today. So I think it's as I said in the beginning, that you have to figure out what is the best price you want to buy certain stocks. And this year you will get multiple opportunities. That's how I look at it.
So okay, power is one. Let's dive a little deeper, because I am very keen on, as you said, build the base for the next phase. So what else?
So
Where else?
others is financialization of savings.
Okay.
So if you think our markets will give 15% CAGR returns, say over a longer period, obviously it's cyclical, you cannot predict on a year-to-year basis. And you think that at least 10% volume growth, then the mutual funds and the wealth advisors, if you plot them ahead, say if you look at them for today's earnings, it will look expensive. But if you plot, say, 5 years ahead, then it starts to look interesting, that they can compound, say, over at least 20% on a 5-year basis. Obviously, there will be cyclical years where you don't get earnings. So financialization of savings obviously is a theme that looks interesting.
On that, so that's the more capital market related plays. But
exactly.
So, but on finance, and you mentioned that with the RBI cuts, credit growth should revive. I hear a big debate in the market now, Sridhar, between whether the best is over for the larger banks. They simply can't grow at that pace. Don't expect HDFC Bank to keep doing what it did over the past decade. Do you agree with that, A? And if yes, then what are the alternatives? Where else? I mean, what are the kind of lenders should one be investing in?
Yeah, so I think I broadly agree. And the other thing is that unlike past periods when we had rate cuts, now it is different because at least 30 to 40% of the loans are linked to MCLR. So as soon as there is a rate cut, your NIMs immediately take a hit. Whereas in the past, it wasn't as much. So the hit on the NIM was far lesser. So if RBI was to play according to what I'm saying, then we could see NIM impact in the next 2 quarters. In fact, most banks that I've met in the last few days have sort of indicated, even without this assumption of a 50 basis point, then at least 25 is anyway going to come, that you will have NIM impact in the next 2 quarters. But I think the market is broadly prepared for that because if you get volume growth and if your credit quality starts to improve, because we've seen a cycle of poor credit quality in the last 6 months, and if that were to improve, especially with the large cap banks, you could see, mid-teens earnings growth. But I would agree that's what you can expect from large banks. I mean, if your book size, if your loan book size is 20 lakh, 30 lakh crores, there's only that much you can grow when the macro is not supporting. But if the credit growth were to come back, then a lot of things will fall into place.
Sridhar, you want to leave us with one name? With full disclosure.
Give us 2.
Maza to tabhi aayega.
No names at all. I mean,
Well tried,
not in my
tried.
last 30 years I've given out a name, so I don't think that changes.
Because, I mean, you guys are, there is so many niche opportunities. Right? We talk about the bigger sectors, but the meat is in the smaller
hidden gems, as they're called.
Right?
Prashant, all that glitters is gold. Prashant is saying 10%, no, 25% of his portfolio.
Gold is a easy one.
Gold has beaten sensex for 20 years. See, Nigel has listened to what I was saying. So what does you're not expecting more than 15% returns, right? On a CAGR basis.
Yeah, absolutely.
Gold has given you a name.
Why bother so much? Itna dimag lagane ka kyun? That's the sense.
Don't go with
Should be your husband's message that later this evening you will be gifted some gold. All right. Thanks a lot, Sridhar, for joining in and giving us all of those details. Well, time to move on then, and let's welcome our next management on the show, Jyoti CNC. That's the next management. It showed actually a good set of numbers in the past year. The past year on the whole as well, the growth has been good, but the pleasant surprise came on the margin parameter. Let's welcome Mr. Jadeja, the Chairman and Managing Director at Jyoti CNC. Hi, Mr. Jadeja. Good morning. Thanks a lot for joining in. Well, a super year, right? When you grow by 35% or thereabouts, some would argue they were expecting a 40 to 50% growth. Keep that aside. FY26, what kind of a revenue growth are you looking at? And this margin number, you were telling us 25 to 27% is the aspiration. You did 30% in Q4. Sustainable?
Good morning and thank you very much. Yes, it was a wonderful year, and this year also we are maintaining the same momentum on FY26. We'll be on a range bound on a similar margin and the growth trajectory there.
Okay, growth. So growth in this vicinity of around 35-40%, and margins?
So growth is now based on our execution capabilities, and basically the way we have a robust order book are there, the way we will, let's say, improve our efficiency will grow furthermore. And margin we will be on a similar range in between 25 to 27.
All right, so you're being conservative. And just to clear the doubt, on growth it will be 35%, right? Or more than that?
I say that now today we have a capacity is going to be constrained, and new capacities are add-on. There are upper sides are possible if the capacity comes early into use of that.
Okay, all right. I got that. Mr. Jadeja, good morning. Prashant here. Now, the growth in revenues is not flowing into cash flows. Cash generated from operations are negative at 16.5 odd crores. Could you tell us why is that, and when do you become cash flow positive?
Basically, now we are just growing on a larger machines trajectory on aerospace and defense, and there are all the now pipelines and everything in bit pulled. So I think this will be turned around, and we are looking in FY26 to be very positive cash flow over there.
Positive cash flow.
Can you give some more sense on that, Mr. Jadeja? By when does this cash flow turn positive? Which quarter? And also, just a sense on the top line growth itself. I mean, to what extent do you augment your capacity? Because I think a lot of analysts are pointing out that capacity constraints were one of the reasons behind growth perhaps being a little lower than what your potential is. So just a number on the capacity addition, and by when do you turn cash flow positive?
Yeah. So first of all, about the capacity, let's say we have just in the last third quarter, our capacity has reached to a 6,000 machine. And it means close to 1,500 machines in a quarter, and we have closed this in the last quarter is close to 90% of that. But in the total, let's say we have built it 4,100 close to the machine, so we can grow by 35 to 40%, not beyond that. We have another let's say capacity expansion is going on from 6,000 machines to 16,000 machines. That will be ready in the next June over here.
Next June. All right.
Cash flow positive, we are looking to be in the third quarter, it will be completely cash flow.
Okay, 35 to 40% top line growth this year and cash flow positive by Q3, right? Got that.
All right, one more matrix, sir, that we track, I think, is the throughput per machine. I think you had indicated that that was gradually moving up as well. If I have the numbers correctly, it was at around 27 lakh and it had moved to around 30 lakh. What is the last updated number, and where is this number headed?
So this year we have clocked up to 44.5 lakhs.
40?
44.5.
45.5. And this trajectory will keep improving because a couple of years ago it was less than 30 lakhs. Now you're telling us it is at around 44.5 lakhs. Will it continue to move up?
So it will be in a range of 40 to 50.
40 to 50 lakhs. All right.
It will be in a 40 to 50.
40, 50. All right. You know, you've mentioned in the past, EMS and semiconductor, that's a big opportunity out there. If I got it correctly, it's still mid-single digits as a percentage of the mix. But I had asked you the last time as well, was there an inquiry from Apple with regard to a big order? Any progress on that front, or have you got that order?
Basically, it's purely a confidential parameter. I have last time also has told you that I'm not.
But you can give us some color, sir, some hint. You know, you could. I mean, since you're so bullish about the space as well.
So we are doing very well over there, and entire not only the one company. We are in electronic manufacturing. We have great opportunities, and particularly in right now this tariff situation, a lot of manufacturing is shifting over here. And the inquiry level is also has been increased very much over there.
So EMS as a percentage of the mix, what can it go to? And the big customer that we're talking about, will it get closed out in this year?
So you will see in a double digit in this year.
Double digit EMS. That means you know, that big customer will be part of the order book at least.
Already they are all let's say
already part of it.
It's a part of that, but we are going to be in the execution side also. We'll look more than 10% over there.
This is a Mr. Jadeja. This is a mobile phone company.
Let's say this is very variety of component manufacturing in been done on our machine.
I see. Right. No. So this is in EMS. You've got. Just to get that, just to finish that point off, you've got one big client there, or you got several for now.
We have many clients are there.
Okay, all right. We'll maybe talk. We'll talk more about this when you want to. Could you give us a sense of where else you're seeing opportunities? Which other end user industries there is buoyancy as far as demand is concerned?
Right now, in entire manufacturing sector, let's say today we are seeing more in a general engineering, and particularly even for EV manufacture components and everything also has been increased. Largely, we are seeing still to be aerospace and defense. And seeing in a geopolitical situation there, even the Europe also, entire Europe is investing after 40 years, and our bases are there in Europe. So we are looking to be a more let's say end user industries are aerospace, defense, and general engineering there.
Okay. You have manufacturing in Europe.
We have a base in France. We have our subsidiary company Huron. It's a base in France there.
Okay. And actually, have you heard more inquiries from European companies for?
Already started. All the inquiries have been started. Germany is investing. France is investing. Italy and all European countries are investing there in defense.
You know, the general sense is most of this demand for defense for Europe will be met by U.S. companies, U.S. defense contractors. Is that assumption correct, or you think Asia, India, where local defense manufacturing is also being given a lot of push, will benefit as well? It's a broader question.
Yeah, right now it's all areas are pushing towards to that. Let's say India also is like that. China also has been like that, and Europe and US is always to be there. But now Europe is getting more and more into these areas.
Okay. All right. So on the working capital days, we had discussed this the last time as well. That was stretched. I think it was 330 days. But you had said that gradually you're going to be bringing this down. What was in the last year? What did it come down to? And I think ultimately you were talking about 170 days. By when?
So this year we have let's say in March 25 we have reached to 180 days. So it's what we were discussing 1 year back to be 330 to 230, and this year we have closed it 180 days there now.
180 days, and there's scope for improvement?
So we are looking to be around 160 to 170 in this year.
Okay, all right. You also mentioned on Huron, that the new facility will be coming I think, getting commissioned in the coming month, if I'm not mistaken, and that adds a good amount of revenue potential. So what kind of revenues did that do in the last year? What kind of revenue will it do in this year?
So basically, there we did close to 27 to 28 million euro, and the facility is going to be ready this end of this quarter, and works will start. So we will see in the next 3 to 4 quarters, we will have a more jump we are able to see into France there. The total capacity we have now reached up to 80 million, and we will augment this capacity utilization will reach within 2 to 3 years to reach the full capacity utilization.
Okay, I think Huran did last year, I think around 250 crores of revenues with around 8 crores of PAT. For this year, in rupees, what will it go deliver?
So we are looking to be, let's say this, the facility will come to us in a June, July to be put to use that. So we are there also, we are looking to be around 35 to in between 50% of a growth rate over.
35 to 50%. All right. So you'll be approximately at around 350 crores plus from this facility. Right? Ballpark correct?
You are nearby.
Okay. All right. Final question before we let you go. EMS, ultimately, since there's such a big potential, I think the last year it was a little bit muted. This year you're telling us it'll go to double digits, but ultimately the plan is to get it to 20-25% of the mix, right?
I say 10% plus.
10% for this year, but ultimately the plan...
More than 10. It says more than 10. Let's say based on that, all the companies are also coming over here and making their own infrastructures. Once their infrastructure ready, our returns will come there to put the machines on. So you will see in the next year and all will be a very quick on that.
All right, Mr. Jadeja, we will leave it on that note. Thank you very much for joining in. That's Jyoti CNC with the projections for this year. Stocks holding up. That's not what you can say for the large part of the market. We need to pay attention to what's been going on because now this is a deeper slide. The index is down almost 0.7%. That's almost now nearing a 200-point drop. By the way, the color across most Asian markets has also changed. The markets that were positive, Hong Kong was the one market that was positive. That's also lower. So suddenly, it's just a overall, mood is on the sell side. The bank nifty is leading the declines with a cut of about 0.7% right now. But it's not just the bank nifty. I mean, it's a wide sell-off. So Reliance, Infosys, L&T, plus the big banks, everything is down. It's that kind of a morning. Let's see if the buyers come in. But right now, it's a decline pretty much all across.
So we Trump tweets, 50%. No, it's not going to be 50%. It's going to be 30%. Then let's do 50. So it's like step forward, two back, and then kind of sort of that kind of a thing. But generally, broadly, of course, I mean the rate of the direction of travel has been up.
Forward.
Slow sometimes, faster sometimes, and has been very, very fast over the last 4-5 weeks. So you got a bit of a cut now. So 24,800 on the Nifty. We'll take a quick commercial break here. Macros in focus. Sakshi Gupta of HDFC Bank and Upasana Bharadwaj of Kotak Bank will be with us to talk about the macros and RBI's recent dividend bonanza for the government of India. Stay tuned.
Welcome back. Continuing to track the market, which is now looking at a cut of about 1%, but it's macros in focus now. Two separate issues to tackle here. One is, of course, the RBI dividend, which came through last week, and it's a large dividend payout once again, 2.69 lakh crore rupees. That's how much the Reserve Bank of India will be transferring to the government for the fiscal year. Now, this is about 27% higher than what the RBI had transferred to the government in FY24. Not just that, remember that next week is the monetary policy. The MPC meeting happens and the announcement is all set for, I think, the 6th of June, which is next Friday, basically. So let's talk about all the macro developments now. Sakshi Gupta, VP and Senior Economist at HDFC Bank, as well as Upasana Bharadwaj, Chief Economist at Kotak Mahindra Bank, are with us. Ladies, great to have you. Thanks very much for joining in. So let's tackle the dividend piece first. Upasana, so, what do your numbers say? The fact that the dividend is higher than last year, it's not as high as what the street was estimating. Estimates were floating of around 3 lakh crores, 3.5 lakh crores. But given what it is, what is the kind of fiscal headroom it opens up for the government, and where do you think the money could be spent?
So here we need to keep into account two things. One, in the beginning of the year, we had also highlighted then that the direct tax collections seem a little optimistic in terms of growth because the income tax cuts were announced. And despite that, the income tax growth was estimated to be around 14.4% on a Y-on-Y basis. So we were already looking at a possible shortfall there. At the same time, the corporate tax collections too look on the higher side, which are budgeted. So we do see almost close to 1 lakh crore worth of shortfall on the direct taxes. Now, to counter that, this 60,000 crore approximately, which is the higher than budgeted number on the dividend, is a good cushion that has come about for the government. At the same time, the excise duty hikes that happened some time ago, that too will be providing some cushion to offset the direct tax shortfall. So I think right now there is no extra headroom which is created. It is actually balancing the risks which were being generated on the fiscal side, especially in a relatively slowing economy, where the tax shortfall could have increased much more.
Got that.
Yeah.
Okay, let me just ask Upasana if she broadly concurs with this. Upasana, your thoughts? Sakshi, your thought, what Upasana is indicating is that this basically just provides a cushion to counter the direct tax shortfall.
Yeah, I, kind of agree with that view. With this higher dividend announced, I wouldn't, be tempted to change my fiscal deficit, forecast for the year. I think the broad, issue is that the budget had kind of assumed 10% nominal GDP growth. But, with how inflation has been moving and the fact that real GDP growth is also, kind of expected to be lower this year, nominal GDP growth could come in, between 9.5%, which does present this downside risk to, the tax collection, growth that was assumed in the budget what Upasana kind of referred to. So at this stage, I think given this, I wouldn't necessarily expect, a huge increase in spending because of this dividend transfer. Or, alternatively assume that the fiscal deficit could be lower than what the target currently is.
Okay, so, before we talk about policy, which is all set for next week, just wanted to get your sense. There was a lot of buzz out there, or I think just general anticipation that because of what's been happening at the border, the defense budget could be perhaps increased or maybe additional borrowing to shore up the whole replenishment demand. Very quick thoughts, ladies, from both of you on this front. So from what you're saying, the RBI cushion clearly cannot be used. It's not sufficient to increase defense spending in any way. But would you expect any other arithmetic or permutation and combination around this at all? Just quick thoughts on defense, and then we'll move on to the policy. Upasana?
Definitely there's talk about this, and there is a high probability that happens. Now, the question is, if it doesn't really happen through the course of the full year, then maybe the necessity of increase will not be as much. Basically, it will spill over into the next year's requirement as well. So we will see higher spending even into the next year. That is one. Secondly, there could be prioritization of spending. So it's not necessary yet that all spending is done across all segments. We might see reprioritization, and some defense spending increase could be offset by cuts in some other segments. So it's not yet a given. We are just in the beginning of the year, and I don't see too much of a risk of a fiscal slippage here at this point in time. Defense spending could increase, but it could come at the cost of some other reduced spending on other categories.
Okay. All right. And, your thoughts, Sakshi? Same question. Do you expect, first of all, slightly higher allocation to defense? And if yes, then where will the money come from?
I mean, it is a possibility that there could be an increase in spending on defense, and not just for FY26, but maybe this is the start of a shift in how much we are allocating to, defense capital expenditure, particularly over the medium term. Right? For this year's fiscal math, I think it is too early to kind of discern whether this would mean any fiscal slippage. Because as I highlighted earlier, there are just too many moving parts at this stage. I mean, we'll have to also see how GST collections, for instance, pan out. are they higher than what the government had estimated? Because that's one space in the whole tax, basket, which has shown continuous, momentum. So, I mean, I think at this stage, I wouldn't necessarily take this as a threat to the fiscal deficit target. I think we'll have to just wait and watch for how things progress over the coming months.
Mm. Okay, so now let's talk about policy, which is all set for next week. Just before you joined us, we actually had a market expert talking about how he feels this is a golden age, perhaps for inflation in India, because the numbers have been trending lower. And some of the estimates are saying maybe in June itself, I mean, we could see, he was saying he expects 50 basis points. But your thoughts on what next from the RBI in terms of whether any additional liquidity measures, rate cuts? Sakshi?
My expectation is that the RBI is going to cut the policy rate, but it's going to be by 25 basis points. I do not expect a 50 basis point cut. I don't think that there is a need for the RBI to be that aggressive in this policy. I think it is true that inflation has been trending down, but at the same time, I think at least for the next 2 or 3 months, we'll have to very cautiously look at the monsoon progress and what is happening in terms of the distribution of rainfall, because that can be very precarious and you can get spikes or volatility on vegetables, etc. So I think the RBI perhaps will be a little, will kind of pace out its rate cuts. On liquidity, I do not expect them to come out with any new announcements. I think the RBI has already been very active in terms of supplying liquidity to the banking system. And I think that is something that they will kind of continue doing. I would estimate system liquidity to remain comfortably in surplus over the coming months.
Okay. All right. So 25 basis points and nothing new on liquidity, considering it seems to be fairly ample at this point. That's the view from HDFC Bank. Upasana, final thoughts. RBI next week, what are you expecting?
I would broadly agree. We're looking at 25 basis of a rate cut. Just to note that the dividend has increased the core durable liquidity and it's expected to continue to keep the core liquidity closer to 5 to 6 lakh crore. Now, that, of course, takes time to filter back once government starts spending aggressively back into the system. But having said that, at this point in time, we overall look at the banking system liquidity also more or less anchoring around 1% of NDTL on a surplus side. Now, which also means that there's no need really for RBI to do anything on the liquidity front. At this point, we expect 25 basis of rate cut. Probably monsoons will be important. So while for the Kharif crops, everything looks good because of early monsoon arrival. But of course, there will be some kind of disruption happening for the standing crops. So we will have to be watchful on that front. But having said that, I think overall the trajectory for inflation looks very comfortable this year. We are looking at an average of 3.5%, and H1 is looking more averaging around 3%. Even if some kind of disruptions happen, I think it could still, have a 30-40 basis upside. Then too, it is at sub 4%. So I think there is headroom for RBI to go ahead with rate cuts. Of course, they may want to pause in one meeting post the June policy and then look at the options open in the subsequent policies.
Okay. All right. Thank you very much both for being here with us. Important thoughts, and it sets us up very nicely for the policy next week. Sakshi and Upasana, thanks for joining in. Have a good day, both of you. Okay, that's a view on the macros, all set for rate cuts next week. The market, by the way, is in a different mood, not feeling too great. Perhaps it's just profit taking, but the cut is now over 200 points. Mid-caps relatively better off. The mid-cap index cut right now is a 0.25%. Let's actually get in our technical expert. Soni Patnaik of JM Financial Services is joining in. Soni, good to have you on. Buy the dip, or what to do now with this kind of a morning decline?
Hi, good morning, Surbhi. Thank you for having me on your show. I think there's this very strong tug of war between bears and bulls around the 25,000 mark. Plus minus 50 points can be kept. As of now, the call writers seem to be dominating that level. So as long as 25,100 bare minimum is not taken out, fresh upside seems quite difficult. Also, India VIX seems to be rising quite high. It is above 18.5 right now. It's just indicating that uncertainty in market direction is what is driving the trend right now. Any break or close below 24,750 in Nifty, you can see further profit booking towards 24,500. The idea would be to approach the markets with a cautious note and stay light on long positions as long as the resistance of 25,100 is not taken out. However, stock specific strategy seems to be telling a different story. We can see fresh longs adding up in multiple sectors and stocks, which seems to be driving individually, irrespective of how the indices are performing. So as of now, the idea would be to stay light on indices and focus more on stocks.
And any names, Sony?
Good morning, Prashant. Certainly. So our official buy recommendation has come in from one of the metal space, which is SAIL. So the idea in SAIL is to buy on declines towards 126 and 125. One can actually accumulate it on those declines, keeping a stop loss of 116.5. And look for a positional target towards 140. It is sustaining above its major moving averages, so I think any declines seen towards its support levels towards 125 can act as a good support levels from where a bounce back is expected. The second official recommendation is buy in Oil India. So Oil India is just approaching its 200 EMA. Once it crosses above a 430, 431 level, it can test higher levels towards 445 and 450. So one can buy in Oil India with a stop loss of 420 and a positional targets of 445 to 450.
All right. Sonia, thank you very much for that. Really appreciate it. So those are individual trades coming through as well. Now, on our news show, The Global Reset on CNBC-TV18 Prime, I caught up with Rajiv Jain of GQG Partners. Rajiv and GQG are the largest foreign institutional investors in India with upwards of $24 billion in assets under management. We spoke about a range of issues. Rajiv, for example, believes markets are complacent in the face of changes which he described as once in decades. He explained why non-tariff barriers are the real hurdle when looking at US-China and US-EU trade talks as well. According to him, India is part of the solution in Trump's ambition to rewire global manufacturing. He remains bullish on India and spoke about the $2 billion he's put to work in new stock purchases he's made in 2025 here in India so far. Listen.
First of all, there was no deal. It was, as the Treasury Secretary said, they had good discussions. Okay, this is not even a framework. I think it was just basically sort of lowering the initial foray of tariffs. So if you look at, for example, the US, at this point, the tariff is 50%. Why? Because the 20% from the prior term. So obviously that's in the prices, but there's 30% on top of that, and China's agreed to go to 10. Okay, so that's the first part. But it is not really a deal at all. I think both have said, particularly the U.S. Side has said that this was a good start to lower the temperature a little bit. And even with the US, UK, by the way, that was again a framework. It is not a deal. I mean, as you know, trade negotiations typically take a long time. And this is not even a term sheet, which both have agreed to. This is a very broad framework. And I think that from a business perspective still remains very, very unclear. Should be, if you're a business manufacturing, let's say in China, I want to move to whether India, Vietnam, what have you, or back to US. Now the tariff, is it going back to zero, or is it going back to 100%, or not going? I think the amount of uncertainty from a business perspective still remains fairly high. So we don't believe there's a deal at all.
I mean, not even a MOU in that sense, not even a framework deal, essentially. And absolutely, you think, China remains the number one, if I can call it that, target, which needs course correction according to Trump and his administration. That very much remains the objective?
So look, I think there's obviously a long discussion, but if I have to summarize, the real crux of, and there was a document released by the White House a few days before the quote-unquote Liberation Day, where they went into detail for every country, what are the real issues in which are impacting U.S. Exports or trade. And they talked at length about non-tariff barriers. So I think even if China, and Chinese tariffs are actually not very high, they are like mid to high single digits, so they can easily go to zero. The real issue, non-tariff barriers. The problem is China started with this Made in China policy 2015, which identified certain key industries, okay, which they would support with incentives, subsidies, and so on and so forth. And now they are leader in the numbers I've seen in more than half of those already. That thing, by the way, is not going to change because those are essentially a lot of non-tariff barriers. For example, technology transfer. China, I don't believe, would ever agree to not sort of having this forceful technology transfer, which was negotiated in the last term also. So non-tariff barrier is the real crux of it. In fact, if you look at, I'll give you one small data point, that Switzerland does not have any tariff on U.S. goods, but we have put 30% tariff and now 10% tariff on Switzerland too. The question is, Switzerland doesn't have a tariff. Why tariff? And I think that what that tells you is that the idea is to bring jobs back. We feel the underlying desire, and there's a good reason for that, because look, industrial base has been hollowed out over the last 30 plus years. And the idea is to bring jobs back. And if that's the case, then Switzerland has very low taxes, right? So a number of large corporates have moved their headquarters to Switzerland to save taxes. So I think it's a whole combination of tariff, non-tariff, taxes to make US more competitive, which is why I feel that China will not remove non-tariff barriers. Both sides are buying time. We shall see what happens in 60, 90 days.
Point taken. So in that context, Rajiv, what is your sense? So China and US, from what I'm hearing, are not kissing and making up. China plus one is an important theme for many countries, right? I mean, countries like Vietnam, Cambodia, etc., benefited during Trump 1.0. India hopes to benefit this time around. Where does that China plus one kind of theme play around in your mind? How do you think about that?
See, if you look at Vietnam obviously is playing the same playbook that has worked very well for East Asia in general. So Japan was the first one after the Second World War, then Korea, Taiwan, Singapore, Malaysia to a little bit till late 90s, early 2000s, till China came along, and obviously China. And India and Vietnam more recently. I think India is slightly different. While India is trying to get the manufacturing side, and I think they have succeeded in a quite remarkable manner, by the way. It's quite remarkable how fast they've been able to, with the right policy mix, to attract manufacturing base, because that helped China tremendously to incentivize and attract these large, sophisticated manufacturers. I do feel that India is part of the solution from a U.S. context. Particularly if you look at Vietnam. Vietnam has kind of become they do a lot on their own, but it's also become a transshipment hub, which the U.S. Trade Representative talked about a number of times, which is why we feel that Vietnam would not be sort of scot-free because it is a big transshipment hub. And hence if you look at the 46% that was announced, was higher than a lot of other countries. Second thing is Vietnam also a big current account surplus. So our framework is as following. We feel that we have to look at countries that have that don't have huge current account surpluses. Countries that have huge surpluses with the US are far more vulnerable. And Vietnam fits the bill, so does Korea and Taiwan. India doesn't have a huge surplus, which means it also shows that it's a huge domestic economy. So we feel from our vantage point, India should be a net beneficiary. There'll be hiccups. There'll be 2 steps forward, 1 step back. But I think direction is clear. India would be on the positive side. Actually, Brazil would be, and Indonesia would be too, versus, let's say, Vietnam or others.
Let's just come to the US, Rajiv, which is, of course, your sort of largest, where your largest investments are. We've seen a massive sort of move from the lows. Where do you stand with your views with regards to US assets? We got a brief period where people were really worried about this big sell-off in US assets. I mean, everything was getting sold, bonds and stocks. That's changed a little bit now. There was talk of US unexceptionalism. I'm not sure if exceptionalism is back in the, but what's your sense, Rajiv?
Well, I think the US exceptionalism, the discussion of that was, frankly, in my opinion, kind of based on the stock price movement rather than anything else, because the US remains the hub for innovation. There's no question about it. I mean, there's not much of innovation in Europe. And even when it comes to some of like China, for example, the cutting edge innovation is not really there. I mean, DeepSeek came 2 years after the OpenAI in US. So I think from a US asset perspective, few important sort of contextual issues in our opinion. If you look at the global trade surplus of these Asian countries, I mean, China has $1 trillion plus. They cannot recycle that. There are two ways. Either you recycle that in US or you have to basically sort of, recycle back in China. You can't do that anywhere else. So I think a lot of these countries, if you look at Europe, where can they recycle? The currencies will go through the roof if they sort of truly bringing back as such. Gold is a tiny market. So we feel the US assets from a global perspective, there's really no choice. You cannot recycle trillions of dollars anywhere else. Okay, the depth of the markets, etc., it doesn't exist anywhere else. So we feel that the whole discussion, people not invest in the US, I think is not very factual based. However, I think the rest of the markets, from a pure investing in equity markets, etc., perspective, valuations in US are on a higher side compared to its own history, compared to where interest rates are, more importantly, than where have been. For example, if you go back to when Trump came to power in 2017, US was around 17 times earnings, S&P was 17 times earnings, with the bond yields around 2%. But now bond yields are 4.5%, and S&P is almost 23, 24 times earnings, depending on the estimates. That's hardly a bargain, and particularly the gravitational pull of higher bond yields is pretty meaningful. So we feel that it is a time to be a little bit cautious. But valuations in non-US world are attractive, and if US doesn't do well, the capital will go into other places where the growth outlook is still okay. And India again actually looks fairly attractive, along with some of the some selective European and other emerging market countries too.
But it's not a sell US assets kind of a thing. It's basically recalibration, which happens all the time in phases. I mean,
Exactly.
Something becomes too hot, too expensive, and money finds more attractive places to go into, which with steady growth prospects, etc. That's the kind of thing you're talking about. Nothing.
Exactly.
Got it.
Because I think I'll give you another data point. I mean, India has been one of the best performing markets within emerging markets over the last decade.
Yes.
Foreigners have hardly been involved. Okay. And multiples, if you look at broad sort of index over the last 6, 7 years, multiples have not expanded that much. Some obviously stock by stock, some have gone up and some have gone down. But if you look at broad indices, they've been rebalancing and so on and so forth. But the multiples have not gone up dramatically. So why has the market done well? Well, because the corporate earnings have been good. So we feel that at the end of the day, corporate earnings matter. And if the corporate earnings are coming through and the valuation is sensible, I think you should get rewarded. And in that context, US looks a little bit expensive. Europe does look a little bit cheaper. But you're also assuming in that the Europe will probably not do well if there's a true global recession, because a lot of those industries are cyclical, right? Banks, industrials. So when you look at valuations, I think you have to look in context of how dependable the earnings stream would be if there's a true recession.
This calendar year put in about $2 billion new money to work in India, right?
Yes. Yes.
And just to sort of for our viewers, you bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back. And then, of course, you didn't own it for a long period of time. You didn't have it last year. This is, in that sense, a new addition. You want to talk to us about that, Rajiv?
Yes, so HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we have doubled down again this year. We've added a little bit to some of the other names too. Nothing meaningful, but they're like a few $100 million here and there. Nothing meaningful. So these are the two big positions. The other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utility/infra type assets, we still like real estate. So and what's interesting, we feel this time around is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap, and large caps are now transitioning from, they've digested last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we were active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
And the way the portfolio here in India is constructed, it's still, I mean, the thrust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they are pretty meaningful. And then you get the infrastructure / utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they are far more predictable growth because the rollout is happening. And that's probably half of our book. When I say utilities, infra combined. And then you get then you get 2 staples. I mean, ITC and Patanjali, right. And then rest is sort of, mixed match of some smaller positions.
Okay, 250 points lower on the Nifty, so 24,757 is where we are at. Now, rate gain is a stock that we want to focus on. Rima is standing by. The results, of course, came through, but we have the guidance now, which the market, of course, does not like. Rima, tell us more.
Indeed. So the company's conference call was yesterday, and they're guiding for a 6 to 8% revenue growth for FY26. This is sharply lower than the 12.5% growth that they had in the prior years. And before that, the company was growing at 50-60%. So this is the lowest revenue growth since FY21, its listing. Secondly, even the margin guidance, 15 to 17%, is a sharp drop-off compared to the 21.5% margins that they had in the prior year. And the company said this is on account of increased marketing expenditure to expand into APAC and Middle East. Now, analysts believe what to watch will be any sort of M&A action. The company has been scouting for M&A. So far, they've held back, citing very high valuations. But now analysts believe that considering the growth is slowing down for the company and they have cash of 1290 crore rupees, perhaps an acquisition is going to be imminent. So that's going to be the next trigger to watch. Today, Phillip Capital has downgraded the stock to neutral. Back to you.
Okay, all right, Rima, thank you very much for that. 8.5% lower. That's a large cut coming through. We'll take a quick commercial break here. We're coming back. Manisha Gupta will be speaking with Ole Hansen, head of commodity strategy at Saxo Bank, on the outlook for metals this year. Stay tuned. Coming up.
Welcome back, and joining us on the show now is Ole Hansen. He's head of commodity strategy at Saxo Bank. Ole, hi, thank you so much for joining in. And we want to talk about the global metals sector. And it seems there's a lot of confusion there. On one side, we did see prices gain after China stimulus measures, also US and China deferring their tariffs as well. But then when you look at supplies, inventories, they have been on the higher side as well. What is your sense on the overall metal as a sector for the rest of 2025 now?
Well, my overall sense is really that the themes that prevailed before this whole tariff war and shenanigans related to that started. But we were seeing an outlook for tightening supply of some of the key metals, especially those for the electrification, given what's happening right now, especially in China. And I think that will continue. But in the short term, the market simply just don't know what foot to stand on, simply because we still don't know the full impact of these tariffs and how they will impact some of the major economies, especially obviously in China, but also the US economy. And that has left us kind of listless here, range bound and struggling to find direction. in addition to that, if you look at a key metal like copper, we still have the premium between New York and London ebbing and flowing. It recently hit a high of around 16%. It just dropped down to around 7-8%, and now it's moving back above 10%. And that's really creating most of the volatility we're seeing in the copper market for now. So generally, I would say the words best to describe the markets right now is confused.
Well, it clearly has been that. But when it comes to copper especially, and since you spoke about that, while yes, electrification is an area where we are looking at a lot of copper demand. But on the other side, the International Copper Study Group also has forecasted copper surplus in this year and in 2026 as well. How have you analyzed those numbers?
Well, that is obviously an interesting development. But I think just overall, if we see how the say the Chinese economy, how they're becoming more and more electrified, we will see that trend continue in the coming years. So I'm probably a little bit hesitant to jump to that same conclusion. Obviously, I'm not the expert compared to these forecasts, but I think generally we have seen how copper throughout the last year, despite some of the worries that related to the setback in China to the property market, the copper has actually held up very well. And it does indicate to me that the underlying demand remains strong. Inventory levels right now are being shifted from the rest of the world to the US ahead of tariffs. That copper is going to create a surplus in the US, but tightness elsewhere, which I think will also help underpin prices. So I'm still optimistic in terms of prices in the coming years, simply because miners need higher prices in order to feel incentivized to continue to increase production, which we believe is still the base case for the coming years.
So $10,000 a ton is what the miners need to mine out more copper, and $12,000 is what you said as well. Moving away from copper and coming for gold then, and I do remember your forecast of $3,500 an ounce by the end of this year, which we've seen already happen in the first quarter of this year. How would you look at the gold prices from here, let's say, for the next 6 to 12 months?
I would have to say higher, simply because the demand from central banks is ongoing. That will continue. And the fiscal debt concerns in the US, if anything, has only been strengthened recently. We saw the spike in long-end bond yields last week, and then we have to remember right now, rising yields is poisonous for the US economy. So where the normal behavior in the market was rising yields would be negative for gold, we're actually seeing that as a positive. So I think the combination alone of central bank demand and worries about the fiscal debt situation will be enough to underpin demand for gold in the coming months. So right now we reached our year target at 3,500. So we're not that aggressively bullish at these levels. But I do note that the last month we've had a correction which was very healthy. We're seeing it seems like we are starting to roll over a bit now that the market is pointing higher once again, and that leaves the door open for higher prices. But I think at this point in time we probably need a trigger because a lot of you can kind of say gold-friendly news has been priced in. So we need a trigger to occur somewhere to move that needle a bit. That potentially could be a stagflationary scenario in the US becoming more apparent as we move deep into the year, and we start to see the negative impact on the economy from the trade war. So that potentially, to me, could be the next trigger that gives us an additional push to the upside.
One of the triggers for the gold prices to go higher could be the decline in US dollar index. We've seen it come down all the way from 114 to almost 98 at around at these levels. It's trading at a 1-month lows right now. Do you see further decline in dollar index? Because that absolutely could be a trigger into buying many of these commodities.
It just looks like the trajectory for the dollar points to lower. It hasn't really got many friends. A lot of people would like to see it, including Trump, would like to see it lower, but obviously in an organized and well-functioning manner. Not we have a panic style situation, but the world as we see it right now points to the need for a weaker dollar in the coming months and years, and I think that will happen over time. We just recently saw how there was a quick move in the opposite direction, and that's clearly what will happen when the bets against the dollar becomes as one-sided as they have been for a while, with an overwhelming speculative interest to be short, that does create these periods of volatility. But I think overall the direction for the dollar is towards lower prices in the coming years.
Since we are talking prices and directions, what's also your sense for the silver prices? Because while the industrial demand has been good, we're also looking at a deficit for a fifth straight year. But would you say that much needed impetus for the silver prices to run up from here or break out is still missing?
If gold can stay here around this close to the 3,500 level, I see no reason why we should not have a go towards 40 later on. But we need some clarity on some of the factors you just mentioned yourself. And once we get that, I see no reason why silver can't do some outperformance once again, relatively to gold with a ratio around 100. It's historically quite high. So silver at this point in time, I would say, looks relatively cheap. But we need the trigger. We need some economic. We need to see the economic outlook stabilize, and when that happened, then I would still be looking for silver to move up towards the $40 level.
Well, as we wind down this conversation, a final question on Indian demand for gold. And while we do see concerns with China and US and within Asian markets, though, India really seems to be shining quite bright. And the kind of demand outlook and growth that we're looking at is quite on the positive side. What has been your sense on Indian demand for metals?
Well, India is a country that's going places. In Europe, it's Poland, but in Asia, in your part of the world, most certainly India. And increased wealth and given metals as a historical, how it's used historically by individuals, then if we are seeing increased wealth generation, then metals will be part of that story. So with that in mind, I see no reason why we will not continue to see robust demand from India. And if we add to that China, then we have some really strong engines that could drive prices forward in the coming years.
All right. All that point is well taken. So a confused metal market in the global sense, but for the Indian markets, the demand growth is quite on the stronger side. A buy strategy continuing for gold and silver as well. And the dollar could see a further decline there. All as always, thank you so much for joining us here at CNBC India. And with that, it's a wrap on Bazaar. Chartbusters is coming up next.